this meeting to order. It's 8:30 a.m. Judy, roll call, please.
Ms. Kevness? Here. Mr. SACRS?
Here.
Supervisor Judy?
Here.
Mr. Stevens?
Here.
Mr. Walker? Absent. Mr. Knudsen?
Here.
Ms. Harris? Here. Ms. Shatmeyer?
Here.
Mr. Goodman?
Here.
And Mr. Shoemaker? Absent.
Okay, let's all rise for the Pledge of Allegiance, please. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. Any public comment? Proclamation.
Who would you like to read that? Who would you like to? The Vice Chair?
Doesn't matter to me. Want me to read it?
Proclamation of the Mendocino County Board of Retirement, honoring Randy Goodman for his service to the Mendocino County Employees Retirement Association. Whereas Randy has been a distinguished member of the Retirement Board, successfully completing 2 terms of office since being elected as trustee by the general membership on November 17, 2008. And whereas Randy has served as an excellent board chairman and a dedicated and valuable trustee. And whereas Randy has helped the Retirement Board make many important decisions regarding operational and financial issues facing the Retirement Association, while focusing on being a prudent fiduciary. And whereas Randy's contributions, including serving as both chair and vice chair of the board and chair of the Audit and Budget Committee, providing accounting and financial assistance to the association, including completion of the association's first comprehensive annual financial report and first award of excellence from the Government Finance Officers Association, successful completion of an Internal Revenue Service voluntary correction plan with subsequent favorable determination letters for 2014 and 2016, implementation of the strategic plan, including policy development, review and adoption, and successful implementation of a pension automation system, imaging system, and member self-service website. Now therefore be it resolved that the Mendocino County Board of Retirement recognizes and honors Randy Goodman for his years of service and expresses its sincerest gratitude. Randy is wished all the best as he continues his career with the County Assessor's Office.
Thank you. It's been a pleasure. Okay, let's move on. Minutes of the board meeting held October 19, 2016. Any objections or corrections? Okay, motion passed by unanimous consent. Consent agenda, any objections to the consent agenda? Okay, motion passes by unanimous consent.
I want to thank you for adding the stuff we discussed last time. Thank you, that was important information.
Okay. All right, discussion, possible action regarding investment report. That would be Callan. Welcome, Greg, and Alina.
Good morning. Is Craig?
Well, good morning, everyone. I'll be kicking it off and doing the performance report. We'll touch on the capital markets. Overall, it was a very strong quarter, so we've got good results both in absolute terms as well as relative terms across all the different asset classes. And then Greg will touch on the second agenda. So with that, if you'll turn behind the capital market review and go to the active management overview tab, which is page 8. The first tab just includes a more nighttime reading on terms of what drove markets in the third quarter. Graphically, page 8 shows the trailing quarter ended September 30th at the top of the page. The trailing 1 year, so 12 months, ended September 30th on the bottom. And a couple observations as we always make. One, you'll see for the quarter the index shown, everything's positive, so very strong returns. Large cap starting on the left-hand side, the range of returns was quite wide, but again, all positive. The index shown here is the S&P 500 and ranked in the 72nd percentile. That's a change from one of the themes we talked about in the last few quarters. The S&P 500 was a really tough benchmark to beat. In the third quarter, that changed. Active managers tended to outperform, and we'll see that in your performance results as many of your U.S. equity managers outpace their respective indices, and that was something we've been expecting. Even for the trailing year, when you look in that same first column on the left-hand side, but the bottom chart, you'll see even despite a great quarter, the trailing year, the index ranks in the 9th percentile. So again, a very difficult benchmark to beat. One of the themes within U.S. equity was small cap has now outperformed large cap. That was a reversal. The last few years, we've seen large caps outperform small caps, and that was a headwind for the MECERA program. You have about 30% of your U.S. equity assets, 30% are in mid and small cap, 70% in large cap, which is a little bit of an overweight to small cap. Those are higher growth companies, and that's something over the long haul that's worked out well. And that's something we'll talk about at the February meeting within the U.S. equity structure. Within the international markets, you'll see for the quarter, the EFA index was up 6.4%, and essentially the same for the trailing year, 6.5% in that third column. For the quarter, you'll see the EFA ranked in the 44th percentile. Within that, generally all markets within the international did well. What's not shown on the page is emerging markets, which we've talked about. They've underperformed over the last 3 years. Well, they really had a nice bounce back quarter and year. Emerging markets in context was up 9%. So your international equity managers have about 15% or so in emerging markets, and that was a big help to the portfolio. For the trailing year, emerging markets is up about 17%. So again, a lot of the things that weren't working seem to have been coming back in favor. And then the fourth column is domestic fixed income. Here the index is, we call it the BB, but they went through a name change, Bloomberg Barclays Aggregate. We've got to come up probably with a better name, but we're trying to shorten it. It's such a long name here, but it is the Bloomberg Barclays Aggregate Index. You'll see it was up 46 basis points. And again, the similar theme is investors were rewarded for taking risk. High yield bonds, which are the riskier area within the bond market, were up about 5%. Dodge & Cox, one of your two fixed income managers, had a decent amount of high yield, and that really benefited their returns. So you'll see your fixed income managers collectively did well over the index. For the trailing year, high yield bonds are up about 10%. So again, the big picture here is good absolute results, and then you'll see a favorable scorecard on a relative basis across your different investment managers based on a lot of these themes I just mentioned.
Thank you, Mr. Chairman. So two questions. With the recent picture, looking back, with growth outperforming value, what is Callan's idea as to why investors' risk appetite has increased? So why are we taking on more risk in the markets? And the second question is, in this fixed income market, what are the core plus managers doing differently?
Yeah, so the first question was just stylistically growth versus value. Historically, we've seen that come in cycles. It's hard to time the cycles. It kind of goes back to that periodic table we review after every calendar year. And sometimes what didn't work last year works, and then sometimes it's a momentum run where you have one particular style doing well every year. Our view is that you should be pretty well diversified across both styles. And then again, that's something we'll address with the U.S. equity structure and review to see if you're committed to that type of strategy. The second part of your question was regarding the fixed income and core plus managers. Core plus is really just the addition of high yield and non-benchmark type sectors.
And derivatives.
Well, derivatives are a way to exercise a view in the market. So that's a type of security, if you will. Core Plus doesn't necessarily mean derivatives, because you could be using treasury futures, for instance, and that's very much within a core bond manager context.
So are they shortening their maturities? Are they, what are they prognosticating at this point?
Yeah, so Dodge and Cox has had a short duration view. That's hurt them, but their bond selection has actually overcome that. Interest rates fell during the quarter. So far in October, they've been going back up. And PIMCO has been neutral to long duration, which has helped during the quarter. But they haven't had the credit exposure that Dodge and Cox has. So it's a mixed bag, depending on what your view is, but you're well diversified, I think, is one of the conclusions. And we're going to talk about your fixed income structure later in the presentation today.
Thank you.
Any other big picture questions? Well, with that, we'll skip over the next tab and go to page 14 and look at asset allocation. And as a reminder, there's a new policy, and that was effective October 1st. And when you look at the actual and target, you'll see the international was slightly higher at 28% versus 25%. And that was intentional. We're rebalancing to the new target that goes into effect the day after this. This is as of September 30th, so October 1st, it's back in line. So as a reminder, international equity will go from 25 to 29, real estate will go from 9 to 11, and fixed income goes from 28 to 22. So the actual asset allocation pie on the left-hand side is more in line with your new December 10th target. You'll see the allocations and the movement on page 15. When you look at that net new investment column, you'll see some red numbers and some black numbers, and largely you'll see the fixed income, about $24.5 million, largely going into international equities to get more in line with that new policy target as of 10/1. Overall, it was a gain of $18 million over last quarter, finishing up at $444 million as of September 30th, with a net outflow of $2.2 million during the quarter. From a structure standpoint, and a theme I mentioned in my opening comments, when you look at U.S. equities, and that's domestic equities, that includes large cap, mid cap, small cap, and micro cap, 30% are in mid cap through micro cap, and 70% in large cap. And again, one of the themes here is that was really good during the quarter. We'll see some outperformance within U.S. equity, and that was a large driver, and different than we've seen in the last year or so.
Quick question. Thank you, Mr. Chairman. You said the investment return was $18 million, isn't it 20.5?
The 18 million was the net
Yeah.
change, but yes, the 20.5 in dollar terms was the return, the investment gain through dividends, interest, as well as capital appreciation on a net basis.
Thank you.
So that's a good segue into returns shown on 16 and 17. The bottom line, I always start with how did the total fund do, and then build the parts. The total fund on 17 at the bottom, you'll see, was up 4.8%. So that's the punchline. Relative to the policy target, which is the benchmark shown right below it, was up 3.68%. So outperformance of about 1.1% for the quarter. Still, for the last year, some of the themes we had talked about at previous quarterly meetings, as well as I mentioned up front, it was a big reversal. And so we've still got a relative hold, but in absolute terms, a 9% return over the trailing year is certainly strong. And as you look on the 3, 5, and 7-year basis, you can see those strong absolute returns. Within and looking at each of the different asset classes, I turn your attention to page 16. Domestic equity at the very top, so this is just how are all your U.S. equity managers doing collectively at their respective weights, how did it all work put together. And you'll see domestic equity versus the passive alternative, which is the Russell 3000, was up 6.5% versus an index up 4.4%. So again, very strong outperformance of just over 2% during the quarter. Still, for the last year, trailing that benchmark, and again, that's some of the comments that we already talked about. And as you go down the page, you can see from large cap, mid cap, small cap, the returns start getting larger until you hit the micro cap, which is at the bottom end of the market capitalization. So these are very small companies. That was up over 11% during the quarter. So it really kind of falls in line with that theme of risk on. Things that hadn't been working over the last year or two have really come back and paid strong returns for the overall plan. There was just a couple of housekeeping items. In our view, no action needed. Under Harbor Capital, Harbor is the mutual fund company, but the investment manager is Jennison. They had a CEO change. It's not an investment person. We don't view this as an issue, but just as an FYI. Within Prudential, QMA is the investment manager under the Prudential Mutual Fund label. They also had a CEO change, not an investment person. It has nothing to do with our expectation of that fund's ability to add value on a go-forward basis. But again, just as an FYI. Janus, one of your other U.S. equity managers, you have a couple different funds there. They joined with Henderson. We don't expect any changes from your investment team. That should have no impact. It's just bringing two companies together, so there's a joint CEO role. So a lot of very high level changes, but from our view, not investment related at all. You'll note Morgan Stanley has been a manager we've been looking at, and that's within the mid-cap equity. They have had a tough run. They are a very active manager, and they have had performance struggles versus the index. This is a mid-cap growth-oriented fund. It did have a pretty good quarter, up over 5%, and outperforming the Russell Mid-Cap Growth Index, and just slightly behind the Janus Enterprise Fund, which has had outstanding returns and continues to perform quite well. And then RS had been also underperforming in years. The recent past also had very good quarters. So again, it's that theme of things that hadn't been working. We've been patient, especially on these more volatile asset classes, really seemed to come back in vogue, and the patience really paid off during the quarter. We'll continue to expect them to do well on a go-forward basis as the market continues to evolve. There's no other questions on U.S. equity. I turn your attention to page 17 and just briefly look at the international equity composite. For the quarter, you'll note the bold line up 7.87%, outperforming the index. Again, similar theme to U.S. equity. Active management had been challenging, and sure enough, for the quarter, it came back in vogue. Oakmark was the lead horse here, up 13, almost 14%, and they have a fairly high allocation to emerging markets. Harris, the investment firm that manages this fund, had an analyst retirement. The longtime portfolio manager and CIO of the organization is unchanged, so we don't view it as a reason to be concerned or have any issues with it. The laggard here is Mondrian, and you'll see they when you look at in the back of the report, they tend to be the more value dividend oriented manager here. So they provide a lot more diversification. And going back to an earlier question about growth versus value, Mondrian plays an important role. It's been a quality growth type cycle we've seen. Those investment managers have done quite well. Mondrian has lagged, but we expect Mondrian to hold up really well if the market should change. And so that's a comment to the diversification we talked about earlier. And we believe they play a very important role in not putting all your eggs in one basket or a similar style or theme. On domestic fixed income, you'll see, again, another very strong return, both in absolute, up 1.5%. You'll see the index is up 46 or half a percent. So outperformance of another % here, and as well as strong results. You'll see Dodge & Cox and PIMCO both outperform the index handily. Dodge & Cox did exceedingly well, particularly over the last year with their allocations within corporate bonds and below investment grade bonds. Greg's going to have more comments on the fixed income structure in a minute, but both firms seem to be doing quite well with respect to their styles and mandates. And on the real estate side, you'll see it slightly under, this is the one area of relative weakness, underperformed that custom benchmark. As you recall, we took steps to change the real estate allocation, so that'll be implemented, I believe, in December. The liquidation of the REIF public, you'll see, was down 2.3%. That had been an area that had done really well, and so the decision was made to liquidate that and reallocate it between REIF Private and the Barings, which is a name change. It's Cornerstone. It's your same real estate manager. They've just consolidated under one brand called Barings. So that's in process now, and I believe the private real estate will take place at the start of the year, next year, 2017. So that gives you a whirlwind review. It's a really good report card. You can see on a relative to peers basis, and I know SACRS is coming up to perhaps present some of the results, but page 25 just gives you a glimpse at other public plans, and you'll see you rank in the second percentile of other plans with the 4.8%. Really buoys the relative rankings across the board. Historically, this plan has done very well on the longer term, both in absolute and relative results. The last year and a half, or year or so, had been challenging with the amount of active managers having a difficult time. But again, that seems to have reversed now, and certainly the proof is on this page that you ranked in the second percentile for the quarter. And certainly we look forward to that continuing, but we'll continue to evaluate it as time goes on.
Mr. Stevens?
Will you speak to on page 25 to the 10-year number for both the fund and the benchmark, and in relation to any change you see for the prospective 10-year period, which I think all your last reports for the last 3 years have been 6.6.
Yeah, so in terms of our capital market expectations,
Well, first, the 10-year return for our fund was what, 6%, and about 5.5% for the benchmark?
that's what it has been, yes.
And that was a gross rate of return. Some expenses are out, but not the majority of our expenses we have, like your guys' fee and Segal's fee and those kind of things.
Yes, the investment management fees are perhaps the largest component of fees, and many of them are net fees in here, but you're correct, there are
So
some.
our gross rate of return was 6% for the last 10 years. And our peers have been about 5.5%.
The median for the public database is about 5.6%, and that's gross of fees. You're unique that you have some of your fees.
Because we have
net,
mutual funds.
Because you have mutual funds, correct.
I'm framing this because we're going to have a discussion with Segal later, and that's why I want to spend a little time on it since it's right in your report here. You want to comment anything about anything prospectively in capital market expectations? Any change from anything you've given us in the past?
No, it really would rely on the work we've done earlier this year as it relates to your policy target. I don't believe there's any changes
There's no change.
we would offer today.
Any other questions? Anything from the public? Okay.
All right, so I didn't have any further comments on the performance report. Again, I thought it was a pretty good conclusion and good scorecard, particularly some of the themes we had talked about in previous quarters showed up and certainly came to fruition. I turn it over to Greg here to see if you have any other comments here or move on to the next agenda item.
Good to move on? Okay, let's do that. So, we met with you several meetings ago and we went through an asset allocation study. And in that study, the decision was made to reduce your fixed income allocation down to increased real estate from 9 to 11, and then put about 4% more in international equity. So that was the big long-term strategic decision you made. You address these big asset allocation decisions every 5 years or so. After we finished that process, we thought we should walk through every asset class you have of the 4 major building blocks, and then confirm, either confirm what you have is reasonable or decide to make a change. So the last time we were up here, we talked about real estate, and we talked about the real estate fund and noted that you don't have a lot of allocation to private investments anywhere, and you have a heavy allocation to equities, so let's take that REIT exposure out and increase your private real estate exposure. We did that in the form of a structure study. We're going to go through now and over the next few meetings and talk about your other 3 asset classes you invest in: fixed income, international equity, and domestic equity, and go through the same process and see if we should make a change there in those individual asset classes. So today we're talking about fixed income, which has been a topic of great interest and concern over the last several years, because the thing that really drives return for interest rates is, fixed income is interest rates. And interest rates are incredibly low by historic standards, and some people believe that they could rise, even though a lot of people believe that for the last 6 years. So we're going to go through today and talk about your fixed income structure. And the first part is going to be educational, just to kind of let you know what sort of investments you have. And then we'll make observations about your current structure. And at the end, we're going to give you a recommendation that you don't change anything. So that's kind of the punchline at the end of the day, but hopefully the background information we give you today will make you feel comfortable that what you are currently doing remains reasonable. Okay? So I'm going to flip ahead into the fixed income presentation here and start off on page 3. And the first thing we note is what is the role of fixed income? So why do you have this asset class where we know the expected rate of return is going to be low? So why do you hold any of it at all? And it's important to remind ourselves that the role of fixed income in a portfolio is to be a diversifier and to be a way to reduce risk overall. We admit that fixed income is going to only produce a 2 to 3% return over the next 5 to 10 years, which is not exciting. But without it, the volatility of the portfolio would be appreciatively higher than it is today if you didn't have this really safe fixed income exposure. The primary drivers of what makes fixed income perform the way it does is how much interest rate risk it has, so the duration of the portfolio, what sort of bonds you buy in the form of sectors, and I'll get into this in a little bit, and then the overall investment quality associated with bonds, whether it's investment grade or below investment grade. It's our account's overall philosophy that in general you should be style neutral to the benchmark over the long run, while letting active managers make tactical decisions relative to the benchmark when they believe it's appropriate to do so. We also believe that if you increase a lot of credit risk in your bond portfolio, you are increasing the correlation to the equity market, and you are losing a big component of the diversifying benefit of bonds if you do that. This leads us to the conclusion that if you have a comparatively low allocation to bonds, which you do, it should be simple, should be very liquid, and it should really serve the role as being a diversifier. So on page 4, we have a graph that shows how fixed income has served as a diversifier over the years. And what we're showing here is that BB Barclay's aggregate index, the Bloomberg Barclays aggregate, is the green bar, So that's the bond index, and then the red bar is the S&P 500. And what we're showing here is anytime there's a negative return in the stock market, what have bonds done? And you see that with all time periods here, excluding one, when the red bars are down, stock market is down, the bond market is up. So this is here to remind you, okay, why do we have this? This is the counterbalance to your risk-seeking assets, your bond portfolio. Well, you might ask, well, what is that one time period where it didn't exist, that relationship? And that was in early '94, and that's when the Federal Reserve surprised the market with an increase in short-term interest rates when people weren't anticipating it. So that is the one risk, that is the one caveat, I should say, about the view that fixed income will diversify equity. It's if the equity market ever is surprised by changes in the bond market, it could not be the diversifier. When the stock market surprises the bond market, that's when the bond market is often a very good diversifier for your portfolio. Okay. So I'll get into a few concepts, and I'll go through some of this kind of quickly, and I'll let you, oh yeah.
I have one question on that, just looking, when we're looking at page 4, and looking at the current price of bonds and the current extremely low interest rate in bonds, is it realistic to expect the same kind of upward performance if we had a major downturn in the market? The point is we don't have, unless we want to go really negative interest rates, we don't have what to give that we've had in historical cycles.
Yeah.
Since we're already priced so darn high on the bond index.
That's right. So the 10-year Treasury yield is about 1.9% and 1.85% right now, and it was as low as 1.37 last quarter. With yields as low as they are, it's hard to replicate an 18% return like you saw in 2000. That's very hard to do. The math is very hard to come up with that return. But let's say your index has a duration of about 5, has a yield of about 2. If interest rates went down 1%, you would produce about a 7% return over a 1-year time period. But you're talking about a scenario where yields are less than 1%. So that scenario is a very bad scenario for the world, right? If the U.S. bonds are yielding, 0.5%, it means that probably means that the stock market is down very meaningfully, and growth expectations are extremely low, and we're entering into a deflationary scenario. So it's a hedge for a very specific time period. Only in those time periods where you get a meaningful return like this.
Yeah, my only point was to say probably the historical cushion is somewhat diminished currently. Is that safe to say?
If the cushion is certainly not as big as it had been historically. Oh yeah, absolutely, absolutely.
Thank you.
Yep.
Mr. Sackless.
Isn't there a little bit another aspect to this cushion as well? There's been a lot of press lately that China and other foreign investors are just pouring into the U.S. fixed income market and bidding up prices, particularly on the high yield, bidding up prices and depressing yields. Do you see that phenomenon continuing, and how will that play out?
I think we could see foreign direct investment in the United States because the U.S. dollar could be appreciating and their currencies could be depreciating. And it's a way, and it may not be that they like bonds so much, but they just don't like their own currency and their own investments. And the U.S. remains the safe haven in times of crisis, right? And in times of shock. So post-Brexit, we saw,
Correct.
yields come down in the United States tremendously. And that was because money was coming into the United States for safety, not so much because we thought Brexit was going to impact our economy. It was more because, well, where's the money going to go if you don't want to hold British bonds anymore because you think the pound is going to plummet? Where's the money going to go? It's going to a safe place, and it could very well be the United States.
And our bonds, the US bonds, are considered high yielding relative to the 12 trillion invested in negative yields like in Japan and Germany.
Right.
And that's pretty profound.
Who quantifies direct foreign investment? Is there a number on that, and who does that?
There's a, I don't know what government agency quantifies that.
But it is
We might have
tracked.
an economist in the room who can answer that, but I don't know that off the top
I'm
of
not
my
sure
head.
which acronym it is
Yeah,
that does that, but yeah, it's one of them.
yeah.
But it is tracked.
Yeah, oh yeah, absolutely, absolutely.
Thank you.
Let's flip ahead to page 7, and here we'll look at the sectors of the fixed income market that are held within the Barclays Aggregate Index. So this is the benchmark. This is the S&P 500, if you will, for your fixed income managers. And you'll see that they have about 36, the index has about 36% of the assets in US Treasuries. So this is the full faith and credit of the United States government. You have about 27% in something called agency RMBS, residential mortgage-backed securities. So these are mortgages that are issued by Fannie Mae, Freddie Mac, and are collateralized by pools of all of our personal home mortgages. So they're all AAA rated. They're not the subprime mortgages out there. But it's interesting that these bond portfolios, 27% of these bond portfolios, that was the index, is essentially residential mortgages. This is the financing of how America actually lends money to people to buy a house. Government-related debt, these are the direct debt from agencies associated with the United States government, which might be different from the federal government itself. And then 26% is corporate. So only 26% of the index is corporate bonds. So these are bonds issued by GE, name a major public company out there. That's about 26% of the index. Now, you give this index to a bond manager, their portfolio won't necessarily look like this, but this is their home point. This is their point of reference. They decide to make active investment decisions relative to this index. So most of the bond managers you have will not hold nearly as many treasuries because they yield so little. And then they'll hold a lot more corporate bonds, and they very well may buy below investment grade debt, debt from emerging market countries, international debt, and all of that is a way for them to express an active view relative to this index. For managers that benchmark their portfolio relative to the Barclays Aggregate, there are essentially 3 flavors of investments. The first is passive, so you can buy an index fund, just like you buy an index fund for the S&P 500. That index fund would look just like this, the pie chart on page 7. There's some advantages to that, and that is just kind of cheap market exposure. But historically, active managers have actually been able to beat this benchmark, so we generally advocate for active management. The next type of way to invest in a portfolio like this is core fixed income. So that is where people manage portfolio relative to this index, but they don't buy a whole lot of high yield. They don't buy a whole lot of emerging market debt. They're a little more risk controlled. One manager you have is kind of close to this definition, and that's Dodge & Cox. They're they're more conservative than other active fixed income managers, and those active managers fall into the description of core plus fixed income. So that's where PIMCO falls in, where they buy a lot of things not in the index, and as John mentioned, they have a significant amount of derivatives in the way they implement their portfolios. On page 10, we give you a little historic background of where we're at here. we show two things here. The average coupon is the red line in the index, and then the green line is the current yield to maturity for all the bonds in the index. So those are two slightly different concepts. The average coupon is literally what was the average coupon of the bond when it was issued. So 10 years ago, GE may have issued a bond that was yielding 7%. Now, if you bought that bond today, you would pay an awful lot of money for something yielding 7%. And that drives up the price of the bond and drives down the overall yield of the bond itself. And what results is the actual yield earned by that bond in the portfolio. Okay? And the green line is the actual yield. And you see that the red line slowly chases the green line over time. Anytime the red line's north of the green line, it means that the price of bonds are above par. Right? So right now we're at a point in time where yields for this index are about 2%, which is pretty close to its historic lows. And we've been down in this area for the last couple of years. Looking at page 12, another key metric for talking about the characteristics of the portfolio are duration and maturity. Like coupon and yield, they're similar concepts, but they're slightly different from each other. The maturity of the bond is literally when does all of your capital come back from investing in that bond? The duration is a different concept. The duration is how much will the price of the security change if interest rates move? And for total return investors like yourself, that second concept is much more meaningful for you. If I hold this bond, how much will the price of it change if interest rates move? So the way duration works is if interest rates go up 1%, your bond declines in value by the duration of the bond. So if you have a bond with a 5-year duration, if interest rates go up 1%, you will lose 5% of value. If interest rates go down 1%, you will gain 5% of value. That's the whole concept of duration. I put out that 5% number because that's the duration of the index. It's a little under 5.5% right now.
If we saw that index go back to its historical interest rate, how much would you expect? I mean, I can do the math, I already know the number, but I want to hear you say it for the benefit of the rest of my trustees. What would you expect the value to decrease of the index?
Okay, yes.
So if we have the interest rate go back to historically what the median's been,
Yeah, okay.
and with the duration, the 5.5 duration you just talked about, how much would you expect with that shift the portfolio to diminish in value?
Well, it matters how quickly it happened. So to know the return of the bond, you need to know which way interest rates move, how much they move, and when they move. So the hard part is when they move. So for example, if interest rates go up 2% over the next year, you're going to lose 10% in principal and gain 2% in interest. So you have a negative 8% return if interest rates went up 2% in a year.
How much interest rate spread is there between the median historical rate of return and where we are on that index?
How much?
So you gave an example if it went up 2%.
Yeah.
Do you know about what the interest rate spread is now between what that index is delivering currently in yield and what the historical yield, median yield has been?
Okay, so how much lower are yields today than its
Right.
historic average?
And if I multiply that by the duration, about, assuming it happened relatively quickly, because over time, some of it, and I understand
Yeah.
that that's just measured and
Yeah.
slow.
Yeah.
But what, I just wanna make sure we understand what kind of shocks potential in the principle of our bonds. What kind of exposure could we have off of a historical measure like that?
Well, I mean, if you
From
know,
interest rate risk only,
so
no credit risk or
yeah,
anything
so
else.
if interest rates, reverted So our 10-year forecast for interest rates expect them to be a few percentage points higher than they are today.
Didn't ask that. I asked historically, between historical and what they are today.
Right. I don't know, I don't know what that number would be, because, so, here's where I'm having a hard time with it. If you look at the 70s, interest rates were 15%, 17%. So if we say, what's the average including the 70s, you could be looking at a 10% yield. If
Do
you
you
say,
have an
what's
average 30? Do you have an average yield for 30 years?
I don't have it off the top of my head. But here's one way you could look at it. Let's say the 10-year treasury yield, and it has historically been pretty close to the leave and aggregate yield, but the ag has a shorter duration, higher spread product. So they tend to be kind of close, within 0.5% of each other. 10-year yield should be the long-term growth rate of the economy plus inflation. So long-term growth rate of the economy, 3% is extraordinarily optimistic. Inflation 2.5%, that's 5.5% right there. That should be a kind of a normative interest rate.
Well, 3 and 3.5 would be 6.5.
3 and
But you
2.5.
took the-
3 and 2.5 is so inflation 2.5, growth rate 3.
Inflation 2.5 for how long?
Well, so a normative long-term healthy economy, inflation 2.5 would be kind of a normal healthy economy, and a growth rate of 3%, which seems like fantasy land right now. But 5.5% on the 10-year treasury yield should be kind of a base case.
So
Call it
4
6%.
times 5.5?
It could go up. It could go up to 4%. But here's where the math is a little deceiving with that. So if interest rates went up 4% overnight, we would lose 20% in our bond portfolio. It would be, without question, the worst bond market we have ever witnessed, and it would be unprecedented. But the way that would only be created by an extraordinary shock, where I would have a hard time guessing like what that would be. It would be every foreign investor never wanting to invest in U.S. bonds. But what's more likely to happen is interest rates, if they do go up, they go up stair step. They'll go up over a 3-year time period and in jagged parts going up. Over that 3-year time period, if interest rates go up, you're actually building a higher coupon. Your income is going to be higher and offset some of the loss. The way you get the highest bond return for the next 10 years is actually if interest rates went up overnight 2% and you clipped a higher yield for the next several years. So it's a tricky math problem. But here's a couple points I'm taking from your questions. One is that our expectation for bonds is low, and 2, we could be looking at negative returns over a 1 to 2 year time period in particular. Over most 3 to 5 year time periods, we should still expect a positive return for bonds.
But a little positive maybe.
Yeah, low. 2%, 2%, modest.
Thank you.
Okay, I'm going to flip ahead to 15, and here's some charts. Do you guys remember looking at these charts in the past? What we do with these charts is we ask ourselves, what has the historic value been from active managers relative to their index over time? And we separate these out by the type of managers they are. So we do this for U.S. large cap managers and equities and international equity managers and bond managers and all sorts of managers. And with these charts, we try to say, should we be spending active risk? Should we hire active managers in an asset class? What's our justification for doing it? Is it just hope that they're going to do better than the index? Or is there some sort of empirical evidence that they have done that in the past? So the way we read this is the top line here, fee hurdle. So this is a fee that we tack on top of an index return over any 3-year time period. And then we ask the question, okay, for median, how often did the median manager beat that index by 20 basis points or more? So how many of the rolling 3-year time periods over the last 20 years have they done that? Okay? Did I explain that well at all? What's the percent of the rolling 3-year time periods in which an active manager beat their index plus a hurdle? Okay? So in the first example here, we see the median manager beat the index by 20 basis points, 48% of the time over the last 20 years. So the average core bond manager kind of beat the index about half the time. This means half the time they didn't, right? And is that, and then we got to ask the question, well, is this where we want to spend our active risk if we think they are only going to win half the time? Well, what if you believe you can pick an above average manager? Let's say someone who will beat the index. So how often would a 25th percentile manager beat the index? They beat the index 96% of the time. So if you think you can pick a top quartile manager, how often can they beat the index? Well, they'll do it 96% of the time. The big takeaway here is that in core fixed income, you kind of have to believe that you're picking an above average manager for it to pay off. And on average, the average manager on a gross of fee basis beat the index by 29 basis points. So the average manager doesn't beat it by a lot, and you have to pick an above average manager to consistently beat the index. That's the big takeaway from this chart. Let's apply the same thing to core plus fixed income, and this is where the managers frankly can cheat. They can buy high yield, they can buy things not in the index. You'll see that their average return over this time period has been 70 basis points, and the median manager beat the index plus 45 basis points in fees 61% of the time. So it means you're winning, 2/3 of the time based on the fee and all of that. This seems to be an area where your probability of success is much higher. So it seems like active management, when you give enough degrees of freedom, does pay off in fixed income, and it does pay off in core plus fixed income. And we've actually witnessed that in the managers that you have, Dodge and Cox and Pimco. Over the long run, collectively, they have done a reasonable job for you.
Yeah, net of fees on a 10-year basis, they've added 60 basis points per year over the index. So it's a good result. This last slide on page 17, I just thought this was interesting for you to look at and to include. Just to frame where we're at with interest rates, and while we aren't happy that U.S. interest rates are so low, look at the other G10 developed market interest rates. And so here, red is anything in negative. Yellow is below 1%, and green is north of 1%. And it's organized by country, left to right, and then the maturity of the bonds up and down. So in Switzerland, 30-year government Switzerland bonds have a negative yield.
It's crazy.
Japan is out to 10 years where it's negative. France is out to 8 years, it's negative. And if you look across the US at the far right, and these are developed markets, right? I mean, if you look at the US to the far right, we're pretty close to the only country that's positive across the board, and we're certainly the country with the most highest yielding securities across the entire yield curve.
Mr. Stevens?
What kind of comment can you make about inflation, looking at that, and specifically the United States last column?
Well, a lot of this has to do with, so when I said, okay, a bond should be growth plus inflation, if your expectation for growth is low and your expectation for inflation is low, yields are low. So this is the market potentially saying a couple things. One, they expect deflation. Or two, it's a flight to quality hedge, and they don't like anything else in the world, and they're just looking for safety over the next 12 months.
I'm framing this for a discussion we're going to have subsequent to you today. When you look at the U.S. column and you look at the 30-year yield on bonds being 2.32, what kind of comments do you have about expectations of inflation in America?
Well, it's either low growth or low inflation, or both. That's what the market seems to be saying. Now, our 10-year expectation for inflation is an average of 2.25%. It could also be that the bond market is not lined up with our expectations, too.
So it could be that there could be some negative growth, right? I mean,
Yeah.
1.6 on 10. So something, either inflation, prediction inflation is too high or growth is too high.
That's right, or the market isn't using my basic model. about
They're
the
parking
way
money
they-
for some other reason.
That's right.
But it would be, basically, if they had the same information you did, it would be stupid money, right?
It would be suboptimal.
That's a good word.
So for over the
It's a nice
third,
plight
four-
for stupid.
yeah, over a 30-year time period. Yes, another thing going on, of course, is governments are buying bonds. So they're buying bonds for non-economic reasons. Well, they're not buying bonds for the same economic reasons we would buy bonds. We buy bonds because we expect a real return coming from them. They're buying bonds to lower the cost of doing business and to try to propel the growth of the economy. So they're doing it. So it's funny. Markets are you can argue markets are inefficient for a few reasons. One reason is when two people view the same security and have different reasons for owning and buying it. You have a non-economic buyer and you have an economic buyer. The economic buyer is trying to make money off the non-economic buyer, who just has to buy the bond. The market is, if it's efficient, it's saying that growth and inflation is going to be summing up to 2.3% for 30 years, which is an extraordinary prediction.
Thank you.
Okay, so on page 19, just to frame where you're at, and Greg Ungerman hit on this earlier, you have half your money in Dodge & Cox and half your money in PIMCO. For simplicity's sake, we call Dodge & Cox a core manager here and PIMCO a core plus manager. The truth is Dodge & Cox has about 10% in high yield, so they don't fit neatly and perfectly in the bucket of core. And you have about $48 million with each manager. You reduced your allocation from 28% to 22%. That took place at the end of this past quarter to fixed income overall. So in our worldview, you have a very low allocation to fixed income, only 22%. So that's leading us to the recommendation that it's only 22%, let's keep it simple, let's try to make it that flight to quality hedge that you need in a very adverse scenario, but may not be very interesting or exciting in a base case scenario or a really good scenario for growth. Your performance for your bond managers is on page 20 in aggregate. You'll note that over 5, 7, and 10 years, they've done a good job beating the index and ranking competitively relative to peers. Over the last 2 years, it's been a little more difficult because the managers have been defensive on duration, and people have been expecting interest rates to go up, and they've done the exact opposite. That's an explanation for Dodge & Cox, and then PIMCO has had some of their performance struggles as well. So the last 2 years, they don't look great, but if you look at longer time periods, I think they've done a fine job for you. A couple quick bullet points on a couple of your managers on page 23. This is where we take a look at Dodge & Cox, and this is their performance relative to the peer group and index over time. And you'll see that the last quarter has really differentiated their performance relative to peers, and part of that has to do with their corporate bond allocation. Greg mentioned high yield bonds were up about 5% in the quarter. And their long-term performance is looking very competitive right now across the board. They have gone through periods where they have had less compelling performance, and 2015 being an example where they were down about 60 basis points and the index was up about 60 basis points. Dodge & Cox is a bottom-up manager. They build a portfolio by looking at bonds that they like, bonds that they think are have value characteristics, and they buy and they hold them. They don't turn over the portfolio quickly, and they don't create the portfolio looking at it from making big macroeconomic calls. Interest rates are going to go this way, the ECB is going to do this. They don't do that. So they're very much a bottom-up manager, and they focus on corporate bonds. You invest in a mutual fund for them, and the fees are 43 basis points for the mutual fund. So when you have about $50 million or less, it's better for you to be in a fund as opposed to being in a separate account, because the custody costs associated with holding all the bonds is meaningful, and especially with the complexity of some of these bond portfolios that you have. On page 25, you see PIMCO. And PIMCO is a very different type of manager than Dodge & Cox, and we think they're very natural complements to each other because of that. So PIMCO is very much a top-down manager. They do come up with broad thematic views about the way the world is going to look over the next 3 to 5 years. And they build the portfolio from this top-down perspective. You will not see them loading up on corporate debt like Dodge & Cox does, or going in and fishing for every little cheap bond that they find in the world out there. So they're a very different type of manager. They're very active in the way they manage duration as well. And because of that, we think they're a very natural complement to Dodge & Cox. Over the last couple of years, they have had personnel change, asset loss, and some performance struggles. And we've had them, we've been keeping a close eye on them because of that. But in our view, we think the ship has stabilized there, and we're not recommending a change for the Mendocino portfolio at this time.
Mr. Sackwitz?
Thank you, Mr. Chairman. A few years back, it was all the rage to invest, for a lot of pension funds to invest in, to diversify into syndicated bank loans. There were a few offerings in that space. I'm just curious, how did those investments fare vis-a-vis the more traditional fixed income offerings?
It's depending on which time period you look at, they've been comparable to each other. And the thing that has benefited the traditional bond portfolios is that interest rates have come down, while the bank loan portfolios have a floating rate, so they don't get that appreciation. But they have a higher yield, and credit spreads have been up and down a little bit, so it's been a bit of a mixed bag, to tell you the truth. There's not one clear winner over the other because of those two kind of balancing factors. A lot of people like the idea of the bank loan portfolio because of the floating rate. Interest rates are going to go up, better being floating rate, and a higher yield. Half of that story has been right, the higher yield, but the other half of the story hasn't worked out to date. Bank loans have done a little better than the high yield market because of the energy allocation. High yield bonds tend to have a higher allocation to energy than the bank loans in aggregate.
Thank you. One final question. How big is that space? How big is that market?
You know, I haven't looked at it in a while, but I think it's probably in the $1 trillion range.
Is it?
But I haven't, it's been a while since I looked at that number, so that's a bit of a guess, educated guess on my part.
So it's mainstream now, it's not really alternative.
No, there are a lot of investors with dedicated bank loan portfolios, but PIMCO can also buy bank loans for
Correct.
you
Correct.
when they think it's attractive,
Correct.
and they do.
Yeah. No, I like that about PIMCO.
Yeah, yeah. So that's another thing about these Core Plus portfolios is that you don't have to make the long-term strategic decision of having a dedicated high yield and bank loan portfolio. And with $100 million, you could split up your portfolio where you got $5 million here, $10 million there, and build this complicated beast. Or you could just give it to PIMCO and ask PIMCO, okay, you make this call for me.
Mm-hmm.
You've got the tactical ability. In the interest of time, I think I'd kind of make a few key points I wanted to make about the rationale for our recommendations. And we'll flip ahead to page 33. And we only thought of 2 viable scenarios for you. One, if you wanted to make a change, and the other 2, if you didn't want to make a change, and in our opinion, we don't think you need to. The current structure we think remains reasonable. We're equally split between active managers who have cruised a track record evidencing their ability to beat the market over the long run. We think you can continue to do that. Or the other alternative is if you just didn't believe in active management here, you could just go out and buy an index fund. But we do think that active management that fixed income has proven to be a space where active managers can add value over time, based on those charts that I showed you earlier.
I will make a motion, we keep our current fixed income strategy.
Second.
Okay, we have a first, and we have a motion and a second on keeping their current asset managed fixed income structure. Judy, roll call please.
Well, any discussion, do you call?
Oh, yeah, any discussion? Roll call, Judy.
Ms. Cavanagh?
Yes.
Mr. Sackowitz?
Yes.
Supervisor Jordy?
Yes.
Mr. Stevens?
Yes.
Mr. Walker?
Yes.
Mr. Knudsen?
Yes.
Ms. Harris?
Yes.
Ms. Shatmeyer?
Yes.
Mr. Goodman?
Yes. Okay, passes unanimously. Anything else?
That's all I got.
All right,
Thanks, guys.
thank you very much, appreciate it. All right.
Thank you, Greg. Thank you, Greg.
We'll have a 10-minute break, be back here at exactly 9:47.
Good job, Greg.
Back to order, we have Andy Young and Dirk with us from Segal, and they're going to go over the item number 6, discussion of possible action regarding the June 30th, 2016 Actuarial Valuation Study. Go ahead, Andy.
Yes, thank you, Mr. Chairman.
Thank you.
Other members, good morning, other members of the board. My name is Andy Young, from Fiscal Consulting Firm, here to present to you the June 30, 2016 valuation. I'm joined by my partner, Dirk Edmondson. If you look at the cover of the report, by the way, if you're following on the hard copy, it is the ring binder, and it says in the front, actuarial valuation and review of the June 30, 2016 valuation. And then it's not to be confused with another report that we'll be presenting right afterwards, and this has to do with the financial accounting reporting requirement under GASB 67. So with us today is the contribution rates that we are recommending to the board, and once the board approves those recommendations, they will be recommended to the Board of Supervisors, and once they're approved by the Board of Supervisors, they will formulate the contribution rates that will be paid for by both the employer as well as the members of the system, starting with the upcoming fiscal year 17-18. So that's included in the cover letter of our report. Our report is organized in a pyramid structure. The table of contents pretty much well laid out how the report is structured. In tab number 1, we have valuation summary. This is where we'll be focusing most of our presentation today, although there are a lot of good information that are provided in section 2, which provides the basis, assets, membership information for the valuation, and that's continued to item section number 3, which includes also some of the other more detailed information. Last but not least, in section 4 is the summary of all the plan provisions that we have used in this valuation, as well as all the actuarial assumptions. So with that, I will ask the board to please turn to section 1, page 1, and this is Roman numeral 1, little I. And as I said earlier on, the purpose of the valuation is to present to the board our recommended contribution rates for the 2016 valuation. Now, when we do this valuation, we have included the benefit provisions that are really not adopted by your board, but really by the Board of Supervisors, together with the 2 other sponsoring employers over at the court, as well as the cemetery districts. We have included the membership data, as well as the assets of the plan as of June 30, 2016. Now, it is very important, especially on the assets, that this is a snapshot based on the return of the fund as of June 30, 2016. I think I've gotten, and the board would be as well, gotten information from Callan, and they have provided you with some good news. Since June 30, 2016, the assets have outperformed the benchmark, but none of that is reflected in the current valuation. That will not be reflected until the upcoming valuation that we will be providing to the board in 2017. Now, with this valuation, we are also not recommending any changes in the actuarial assumptions. So you board may remember, you make a decision 3 years ago or 2 years ago now as part of the so-called triennial experience study as of June 30, 2014, as to what the investment return assumption is that we would use for the 3 valuations. And we have used the 7.25% assumption since then for the 14 valuation, for the 15 valuation, as well as for the 16 valuation. So this is the last time we'll be using that assumption for this valuation. So similarly, not to belabor the point, we have continued to use the same inflation assumption that was adopted 3 years ago. So that assumption was 3.25% in the 2014 valuation, and we have carried that over unchanged in the 15 valuation, 16 valuation. Again, those assumptions will be reviewed as part of the 2017 triennial experience study, which we'll be doing in about this time next year. So as far as assumptions are concerned, no change. It is because the board's policy is to look at over those assumptions every 3 years. Down at the bottom of the page, we have also provided the so-called amortization policy. We have an unfunded liability in the plan. We'll go into in a second how much unfunded liability we have in the plan, but we do have a payment plan, just like our mortgages on the house. We owe the mortgage, we go to the bank and we arrange for a mortgage, and that mortgage will need to be paid off over a certain number of years. We'll look into that in a lot of detail, but again, with this valuation, we are not recommending any change. The reason why we don't recommend the changes, the board has looked at its funding policy, including the amortization policy back in 2013. Again, until such point in time when the review is necessary, with carryover and change that amortization policy. So for the fund, to go on the record, we have 2 different periods that we use to amortize this so-called mortgage, the unfunded liability. We have a huge chunk of unfunded liability that we have carried over from the 2012 valuation. For that big chunk of unfunded liability, which I will define once we go to the regular presentation of the report, that is being amortized over a period, a declining period, and we have 23 years left in that amortization period. Now, it's very crucial to remember the 23-year period, because when I go to the amortization schedule, I will remind the board that because that period is longer than the magical number 18 years, we have the so-called negative amortization. Negative amortization in layman's terms is the payment that are being made by the employer are not sufficient to pay the interest on the unfunded liability. So that is the reason why, if you look at the schedule, which I will go through in a lot of detail with the board today, you will realize that, well, wait a second, when I compare the outstanding balance of that loan, how come it is bigger than the amount that appears in our valuation report from last year? It is because of negative amortization, and I will try to illustrate that. But it is only with respect to the original loan that was established and carried over as of June 30, 2012. Because the board make a conscious decision, you don't want negative amortization, and for that reason, any mortgages, any unfunded liability that was identified since the 2012 valuation has been amortized over a period of no longer than 18 years. We use 18 years for the current loan, we use 17 years, which is 18 minus 1 from the last year, and so on. So that's something that is worth remembering. But we're not recommending any change, only because, again, this is part of your actuarial funding policy. So with that as a backdrop, let's turn over to page II. So before we go into the contribution rate recommendation, so let's take a look at the funded status of the plan. Funded status is simply a comparison of how much assets we have in the plan relative to liability. So in the ideal world, we like that target to be 100%. So which means for every dollar worth of liability, we have $1 worth of assets to cover that liability. But we don't have that ideal state at this point in time, because if you look at the unfunded liability, the funded status in the last valuation as of June 30, 2015 was 70.2%. In this year's valuation, if we look at the smooth value of assets, this is the assets that we use for the valuation, after we go through the so-called asset smoothing methodology, that funded status has inched up a little bit, 70.7. But if we measure the funded status on a market value basis, so we don't use the smooth value of assets where its investment gains or losses are not recognized immediately, but recognized over a period of 5 years, that's the asset smoothing method. But if we don't use that asset smoothing method, we just jump to the market value and use that to measure against the assets. That number actually has come down. The funded status has come down from 72.8% to 67.5%. So that means in this year's valuation, unlike last year, we're sitting on investment losses that we have not yet recognized. So that is the reason why the funded status actually would have come down from 70.7 when measured on a smooth value basis, which does not recognize all the market losses, to 67.5% once all the market losses are put into the calculation. On the other hand, if you look at last year's number, last year we were sitting on market gains. So that's the reason why last year's funded status would have been 70.2% when measured on a smooth basis. But if we use market value, it actually would have gone up. We were sitting on some market gains that we have not recognized. So on the second bullet, we look at the absolute, now that we know the change in the funded status. So let's take a look at how much the absolute dollar amount of the unfunded actuarial accrued liability, or UAAL for short, has changed over the course of 2015 and 2016. That number has actually gone up from $182.2 million as of June 30, 2015 to $185.3 million as of June 30, 2016. So there's an increase in the unfunded liability of about $3 million. Now, if I look at the page reference on the left margin, that's where we would see the detail.
Let's let Andy get through his opening first, and then we'll open up for questions.
Okay, thank you, Mr. Chairman. So if I may ask the board to now please turn to page 46 of the report for me. So page 46 is section 3, exhibit I. So section 3, exhibit I, page 46. We have provided a reconciliation of how the unfunded liability has gone up from $182 million at the beginning of the year, which is on line item number 1, to item 7, which is $185 million. So that's the number we have calculated as of June 30, 2016. Let's go through item 1 through 5 very quickly. Item 1 is the unfunded liability as of the beginning of the year. Again, $182 million. During the year, our members have put in, our active employees have put in another year of service, so that's the normal cost. Employers as well as members expect to make contributions, so that's item number 3, a reduction of a release of the liability of $24 million. But we do have to apply interest on the unfunded. So if all the actuarial events were to be recognized, all the assumptions were to be met, the unfunded liability of the plan would have gone up a little bit from item 1, which is $182.1 million, to $182.8 million, which is in item 5. And now again, a lot of this has to do with the fact that we have negative amortization. The interest we charge on the unfunded liability is less than what is being paid by the plan sponsor, at least in this case, the county, the court, and the other cemetery district employer during the year. But we do not have as much negative amortization as it has been in the last several years. As that unfunded liability payment period came down from the current period of 23 years, and it's marched down to 22 years in the next valuation, and until it goes down in about 5 years' time to 18 years, we expect to have at least some unfunded, at least some negative amortization. But that's not the real reason. The main reason why the unfunded liability of the plan has gone up from $182 to $185 million. There were several events which took place during the year, though these are what are generally referred to as actuarial gains and losses. Now, if we look at item 6A, so that is the always the part which is the most variable. So this year, for this year's valuation, we have losses from investment. I think you have to look at the calendar report. You know that last year was a very challenging year up through June 30, 2016. Rate of return was a negative 2% plus change during the course of 15-16. For the purpose of this valuation, we don't use the market value of assets, but rather any investment gains and losses, and in this case, the investment losses during 15 and 16 is recognized only 1/5 at a time. So we've taken the investment losses, but recognize only 1/5 in this valuation. Now, I should be more precise when I define what that investment loss is, because earlier I mentioned that we have a loss of -2%, but that is not the loss that we have to cover as a result of the actuarial valuation. Because in the valuation, all the liabilities have been discounted at an assumed earnings rate of 7.25%, which is the assumed earnings rate. So anytime you earn something less than the 7.25% earnings rate, that is referred to as an actuarial loss. So if I were to be more precise in coming up with item 6A, the investment loss, I should have added the amount that we expect the fund to earn, which is 7.25, and the amount the fund actually lost in investment, which is about 2% plus change. Then that's the amount that would have to be recognized over a period of 5 years. So that's we have a schedule coming up in the front of the report which recognizes that. So bottom line is, if we take the investment losses and recognize only 1/5 of that, but take into account that last year we were sitting on some deferred gains, that rainy day fund, so to speak, that we are wanting to mitigate any investment losses such as the year that we are in. Net, the rate of return on a smooth value of assets basis is actually still a positive 6% or so. So there's a page again in the report coming up. But that's still nonetheless resulting in an investment loss of $4.7 million. Now, I want to note for the board that, let's look at 6B. 6B is salary gains or losses that have been applied to the active members by our sponsoring employer, again, the county, the court, and the cemetery district, during the course of 15-16 year, different from our assumption. Now, in this case, there's a loss of $2.3 million, meaning that at least during the course of 15-16 year, salary increases that have been granted by the sponsoring employers have come in slightly higher than what we have expected. Now, this is the place where I want to note for the board, though, that this is actually the first time, I think in 5 years that we have served this board, where we have seen a salary loss. Whenever I say this whenever I categorize this as salary loss, I want to be quick to point out that these are salary increases that are granted to our active members better than what we expected, than the assumptions. So which means that finally, active members are getting salary increases. Now the flip side is true. When we were measuring these metrics during the course of the last 5 years, if you look at all the magnitude of the salary gain, meaning salary increases did not come in as expected, that number was much, much higher. I think in the report that was prepared by your administrator, Dr. Wilbanks last week, if you look at that amount turns out to be over $30+ million. So this is really the first time since we have been appointed as your actuary that we have finally seen some salary gains. Or salary losses, meaning that active employees are getting salary increases greater than expected. But in the past, because there have been salary gains, that amount has been used and is more than sufficient to offset the investment losses, at least during the time period from 2011 to 2015. All of that are included in Dr. Wilbanks' report to the board from last month. Okay, any questions? So then item 6C has to do with the 1 year.
Mr. Stevens? You got a question?
My question is about the unfunded liability. Since you've been our actuary, 5 years, is that right? I think since you've been our actuary, it's about double. The unfunded liability is about double. How many other 37 Act companies do you, associations do you act as actuary?
Including MECERA, Segal as a company is the actuary for 12 of the county retirement systems.
12 plus us, so 13?
No, 11 plus you.
11.
Yes.
And some of them have you had for quite a long time?
I have a client that I've served since my first day on the job, not with Segal, but with my predecessor firm. That company has retained me as the actuary for the last 30 years.
There's 30 years?
Yes.
Okay.
Yeah.
So from my perspective as a fiduciary, I'm getting, as you know, in the past, I've been very concerned and I've been very suspect about some of the methodology used here. In my industry, it would be unacceptable, and I'm in the financial industry. What I wanted to get an idea of those other 11, if I'm in a take this and accept it to fund this plan, which seems to be continuing to diminish the funding in it. It's getting worse and worse and worse. And the recommendations are pretty much a very wide variance from what our investment counselor that was just here said. But here's my question. I would expect to give credibility, I would expect that your recommendations to the other 11 would end up being half of them would be overfunded and half of them would be underfunded, if I'm to believe what I'm hearing now and reading every year for 6 years now, and studying it 2 years before, is how many of those 11 are 100% funded?
None of them are at the time.
Pardon me?
None of them are at the
None
time.
of them. So the methodology that you're asking us to accept in this contribution rate hasn't worked for a single client you have?
I disagree with that statement, and if I may, through the chair, provide an explanation. Since we became your actuary in 2011, we have gone through 2 of those experience studies that I was referring to, the triennial experience studies. In those 2 studies, it was Segal who recommended that the board adopt more conservative assumptions. So at one time, when we first was appointed as your actuary, the investment return assumption was at 8%. The first time we go through the experience study, we recommend that the board approve our recommendation to a 7.75% assumption. Now, unfortunately, anytime you adopt more conservative assumptions, you put more unfunded liability on the books, because we measure all the past liabilities, whereas in the past, all the assumptions were made that in the future, the assets will earn return of 8%, but that did not happen, so we true up the liability, and that put a certain amount of unfunded liability on the books. I'm looking at a report that Dr. Wilbanks put together for the board last month. That's $24 million. We came to the board again in 2014. We recommend that the investment return assumption be lowered again. It was Segal's recommendation to go from 7.75 all the way down to 7.25%. And again, that require us to true up the calculations that have been put forward up to that valuation, that again increase the unfunded liability by $50 million. I think the long and short is no good deeds would go unpunished. Anytime we recommend more conservative assumptions at this board, and anytime we recommend more conservative assumptions be adopted by other county retirement systems board, we remeasure the past liabilities, and sure enough, those truing up the liabilities always increase the unfunded liability of the plan. Now, if I may finish, if you look at the report that Dr. Wilbanks put together last month, during our tenure with the board, the unfunded liability has gone up by $57.3 million. However, if you look at how much of that unfunded liability was caused by truing up of the assumptions that were recommended by Segal and approved by the board, that number was $77 million. So of all the assumptions, of all the events that have taken place, the 2 that are most significant that took place in this county, and because we routinely do experience study at the other jurisdictions, and unfortunately for the last 5-6 years, those assumptions have been true up, and every system, with no exception, have to put additional liability onto the books. And so that's the reason why I said it happened in this county, it also happened in the probably 11 other counties that we saw.
The problem I have is just this year alone, we added on a market value basis $40 million of debt. The prior year, we added $24 million. The year before that, we added $15 million. So that's $79 million in 3 years. If I take a look at our county financial statement, which lags in the financial statement put out last year, it uses the prior year, it wasn't able to use last year. I mean, it's totally clearly by the system. I have it right here. So we have total assets since we incorporated in 1850, 166 years, of $201 million. This association right here has created, and it doesn't include the additional 24 last year and the additional 40 million this year, and the extra 64 million is not included in this number, 212 million in debt produced by this association's policies right here, because we have absolute responsibility for funding, as opposed to 201,000 in assets. We've wiped out completely the assets of our county for 160 years with the same methodology you're telling me, and interest rate is only one of them. And remember, I made a very large push when we did it at our triennial study 2 years ago to go what our investment counselor recommended. If we look in the rear view mirror on our investment counselor, we should have we should have had a target rate of return at 5.6%. And that's rear view mirror 10 years. Looking forward 10 years now, it should be a 6.2. It should be fully at least 100 basis points less than it is. I've made this and that's only one component. If it was only the investment interest rate that was haunting us, I wouldn't be nearly as agitated as I am now. But if you look at the what's happening, we have people living longer and we have people retiring earlier. They don't drop off, but when they do drop off, they have a little tiny pension. We have a huge pension, someone coming on early and staying. Look at the dynamics. Look at the dynamics of the people that are active in the plan as far as working, as opposed to those that are retired or waiting to retire because they have a vested interest. And the dynamics are, every time I look at this, is getting worse and worse. Every angle, and that's not only that doesn't have anything to do with the investment rate. That has to do with the money coming out of the plan. You look at these huge contributions that have gone up in this plan. Still, we have to sell a third of our expected rate of return on a grossly underfunded plan, about 2/3 funded. If a private plan would be mandated to stop paying benefits, no current employee has a single dollar going in this plan. We're selling investments to make the benefit payroll. I mean, Charles Ponzi must be applauding in his grave. I mean, it's unbelievable that I look here and you're telling this is fine and the smoothing and everything. In the last 3 years, $79 million additional in debt. And can you tell me, okay, so you told me the investment interest rate surprised you. You weren't able to predict it. How about all the other things as far, when we talk about investment rate, when you guys did your actuarial study, did you ever include in your triennial study or your actuarial reports the effect of excess earnings skimming?
Do you mean?
When you came up with a recommended target rate,
Yep.
and you had Sonoma County's one of your clients, they did it to pay, they paid it to use their COLA. They have a very unfunded plan too. Were you including in your actuarial study, in your triennial study, the practice of taking all the good top earnings above their target rate and leaving all the losses? Was your methodology including that practice when you were telling them how much to put in the plan?
Now, through the chair, our general practice is really to not talk about another client in front of this client. But I can answer that question at least for Sonoma. What happened was we have been retained to work on that account for about 10 years. During our tenure with the board, we have not experienced the need to answer this question because quite honestly, they suffer investment losses like we do since 2008, and as a result, there's never an instance when there's available excess earnings to even provide for COLA. We have cautioned the board that that practice is something that may not be sustainable, and we have a policy discussion with them. But
that was my question. My question is for the 11 other clients you have. I'm trying to get where I can say, okay, I believe in what these guys are doing. I feel comfortable as fiduciary that our beneficiaries in this plan are going to get a benefit. So that's what I'm trying to get. And one of my questions was, if on the other 11 plans you have, if they had excess earnings, when you built the target rate, did you take into consideration your client skimming all the top returns and leaving all the bad returns? In your model, was it predicting that?
I want to say that of all those clients which used to, before the recession in 2008, provide for the so-called excess earnings benefit, all of them have stopped doing that since 2008.
When they were doing it and they were your client, did your triennial experience and did your recommended contribution rate include what was actually happening inside the association, or was it, I know the answer, or did you disregard it in your recommendation rates?
We disclose the impact, and it's really.
Did your rate predict that that practice was going on?
We disclose the impact. That's the only thing we can do.
Mr. Wilbanks? I would like to, with all due respect to Trustee Stevens, the characterization that this board has created all of this debt, I think is inaccurate. This board manages this plan and administers the benefits as defined by our plan sponsors. The plan sponsor sets the benefits, we administer those. So to characterize this board as having created, to use his own words, the debt, I think would be, I would characterize that as inaccurate. We administer the plan that's given to us. The largest single component of our liabilities is the benefits. Those we do not control here. So I would, with all due respect, object to that characterization of what this board has done.
Andy, continue, please. No, Andy will continue, please. We'll get to more questions later. Let's get, finish, Andy.
So we look at item 6A, investment losses. We look at higher than expected salary increases. Again, it was a loss this year, but during the last 5 years, we have salary gains, meaning that salary increases are coming lower than what we have expected. There's a 1 year difference between when the contribution rates that were approved by the board in the last valuation are put into place, so that always resulted in some actuarial gains and losses. Because the contribution rate actually decreased at the last valuation, therefore in this year's valuation there's a small gain of $264,000. There are always some other experience gains and losses. In this year, the number is kind of big, it's $4.3 million. So we decided to explain what those gains are. So if you look at the footnote on the last page, it really has something to do with the refinement in the data that we got passed on to us from the pension goal system. There were certain retirees that were reported to us in the past that were assumed to have been beneficiary who would be entitled to the 60% automatic continuance benefit. So this would be the benefit paid to the spouse or domestic partner. So upon looking at the data more closely this year, it was determined that some of those members really do not have a spouse as of today, as of the date of the valuation, that would be entitled to the continuous benefit. So this has been used to reduce the liability by about $4.3 million. So on a net basis, we still have a loss of $2.4 million, and you can see it's primarily caused by the investment losses as well as salary losses that happened this year but not the prior year. Okay. So let's go back to section 1. So now we take a look and see how we got from where we were at, how the unfunded liability has gone up from 182 to 185. So we are going back to section 1, Roman numeral 2, double I. So the next item that we'll be looking at would be how the employer contribution rates have changed. So in this year's valuation, the aggregate rate, when averaged over the county, the court, and the cemetery district, have decreased slightly from 32.14% of payroll to 32.05% of payroll. And again, the reasons for those changes are spelled out here. We look at the schedule on page 19 in the second, but these are due to a change in demographics. Basically, entry age of the members have gotten a little bit younger, and there's a small reduction in the normal cost rate. For the first time in many years, we have payroll growth at the county, which are higher than what we have expected, which is 3.75%. So whenever we take the unfunded liability and we spread it and amortize that over a payroll base, which is greater than what we have expected, we, even though we are asking the employers to pay the same amount of contributions to pay off the unfunded, but the rate that we are charging the employers would be slightly smaller, so that is happening. And we have some other actuarial gains. And so those reductions, the factors that cause a reduction in the rate, some of that are offset by, for example, the two reasons that I was talking about, investment losses as well as salary gains that are higher than what we've expected by the assumptions. So with that, let's turn to page 19 and see what those amounts are for 2016 valuation. So this is on page 19. So now I'm in section 2 in chart number 14. So this page Actually, it's very similar to the entries that we have seen on page 46, so I will just go through the items that you would only find in the rate reconciliation, but perhaps not in the UAAL reconciliation that we were looking at a couple of minutes ago on page 46. The contribution rate, again, at the beginning of the year in the last valuation, 32.14%. In dollar terms, is about $19.67 million. This, again, is a contribution that is in the total aggregated among all the employers. So I always want to remind the board there's really no employer in our plan, including the county, that is paying at this particular rate. It is really an average among the 3 employers. Line item 1 is one of those items that you will only find in the rate reconciliation and not in the UAAL reconciliation. So this, again, has to do with the change in the membership demographics. Every year, for obvious reasons, we don't have the same exact members that were provided in the 15 valuation, again, reported in the 16 valuation. So we always refer to this so-called change in demographics. We changed the normal cost rate that we calculate in the valuation. So this year is slightly positive, meaning that there's a slight reduction in the contribution rate by 0.13% of payroll, or about $81,000. We have already talked about the effect of the 1-year delay in implementing the contribution rate. So for this year, because the contribution rate is actually going up, it's going down, I'm sorry, and it's going down by a little bit, so there's very little adjustment. But in prior years, there's always some adjustment in line item number 2. Investment losses create a contribution rate increase by about 58 basis points, or $355,000. Higher salary increases also increase the contribution rate by about 0.29% of payroll, or about $178,000. So these 2 items, again, we have seen on the unfunded liability reconciliation page. So the next item coming up is some item that you will only see on this page, and again, this has to do with how we amortize unfunded liability as a level percentage of payroll. Every year, we assume that payroll we were provided with in the 15 valuation will grow at the assumed rate that is 3.75%. This year, the county has added some new employees. Pay increases have taken place, so for that reason, we have a bigger payroll base to spread the same amount of unfunded liability, everything else being equal, and the contribution rate has come down by 31 basis points, or $190,000. So effect of other experience gains, so that goes back to the data cleanup that I was talking about as a result of the transition migration to the new pension goal system that reduced the contribution rate by 52 basis points, or $314,000. So net, if you look at all these entries from line item number 1 through 6, there's a small reduction in the contributions by about $52,000.
Mr. Stevens?
If a sponsor comes to you, a plan sponsor, and says, what do we need to do to make sure we have the money to pay the participants in this plan? What does it take to do that?
Two-part answer to your question, Mr. Stevens. First, they have to pay this rate that the board hopefully would adopt at the end of the day, the $19 million. They would also need to pay a number which is comparable to the 32.05%, or another number that we've calculated on the market value of assets basis, taking into account the investment losses over the next 18 to 19, over the next 22 to 23 years. So they need to make the payment today. They need to be able to make payments for the next 23 years.
Has that changed over the last, since we've had this plan?
Changing what
Is that what you've just said, the ingredients to make sure we have a funded plan, has that changed over the last couple of decades?
No, other than the fact that the contribution
Who,
rates have been.
you understand the 37 Act, who has responsibility to make a recommendation on that rate? What body in the 37 Act has the responsibility to make a recommendation on that rate, which you just told me totally controls the funding of the plan? Who has that responsibility?
Now, this is a legal question, so I will attempt to answer that based on the actuary's understanding. I'll look to Jeff to make sure that I did not state that incorrectly. It is my understanding that the Board of Retirement has the power to recommend a contribution rate to the employer. In formulating their recommendation, the Board of Retirement would have to consult with his consulting actuary based on the input and advice from the consulting actuary. Then the contribution rate, such as the 32.05% that we are sitting in front of us, would be recommended by, actually adopted by the Board of Retirement, and then that rate is then recommended to the plan
Thank you.
sponsor.
That's my understanding too.
Okay. So that's the reconciliation, how the employers' rates have changed from the 2015 and 16 valuation. Now, without going back to the front, maybe we'll take a look at the employees' contribution rate, which are provided on page 20 in a similar looking chart, 15, except that in this case, there are very few entries because the employee, unlike the employer, are not responsible for paying off any of the actuarial and funded liability. So anytime there's an unfunded liability, be it a reduction in the contribution rate or an increase in the contribution rate, that would always fall on the shoulder of the employer. So for the members as a whole, for the system as a whole, this year is relatively small change. Whereas the individual employee rate may change from last year to this year, but if you look at that for the plan as a whole, the employees as a group, if we look at all of our employees working for the county, working for the court, and working for the cemetery district, as a body, they would be expected to pay a slightly higher amount of about $6,000. So then go back to page, section 1, one more time, please. I'm looking at Roman numeral 2, double I. As I was alluding to earlier on, so I've gone through the first two bullets, touch on the employer contribution rate when we're looking at page 20. So now looking at page 5 and the last bullet on this page. As I touched on earlier on, in this year's valuation, there's a schedule coming up, but if we look at the bottom of page double I, Roman numeral 2, because of assets movement, we have not reflect all the market losses. Remember I said we expect the fund during the course of 2015 and 16 to earn at an assumed rate of 7.25. In reality, the rate of return was a little bit less than a negative 2%. So we have not recognized all the investment losses because under the board funding policy, which is recommended by Segal and approved by the board, we take any investment losses such as this year, or we take any investment gains such as what happened the year before in the 2015 valuation, and only recognize 20% of that at the time. So the long and short is, if we look at how much we have yet to recognize, the investment losses we have yet to recognize, it's summarized at the bottom of page double I. That amount is $24.7 million. The investment gain that we're sitting on, the rainy day fund that we were sitting on last year that we did not recognize in the rate setting process, was $11.5 million. So this goes back to Board Member Stevens' question. In a one-year term, we've gone from a huge swing from net positive, we earned more than expected, to a less than expected position. If you add up the two numbers, even after recognizing some of the losses, you're looking at, for a fund our size, a good $35 million, which is very significant, I would agree. So the $24.7 million is about 5.8% of the market value of assets. So in other words, unlike last year when we were sitting on investment gains of 11.5 million, this year we were sitting on market losses, which is about 5.8% that we have not yet recognized. Now the rate impact is quantified on page triple I. We'll first answer the same question again, which is what is the impact if we're not recommending that, but if we were to take into consideration the market losses in developing the funded status, so what would that mean? So the funding status, as we have seen on the previous page, would decrease from 70.7 to 67.5. The contribution rate that we are recommending in this valuation, if we were to use market value of assets, which we are not recommending, but if we were to use market value of assets, the contribution rate in this year's valuation would have gone up from 32.05% to 34.8%. So this is one page where, if you look back at last year's report, the exact opposite would be true. The funded status would have been better if we use market value of assets. The contribution rate would have been smaller if we used market value of assets, because in the last valuation we were sitting on market gains of 11 million, but of course this is not the case this year. We're now sitting on market losses. So finally, if you want to see, okay, well, exactly how much of the market losses in total of 24.7 would be recognized using the so-called assets moving method over the course of the next several years, we do have an answer to that as well. It is on page 5. So this is page 5 in section 2, which is in chart number 7. So very quickly, without going through a lot of detail, so section in chart 7, if you look at line item 2, so this gives in the last 5 years, the years that we have earned less than the assumed rate of return, or the years that we have earned more than the assumed rate of return. So if I look at line item 2E, this is for the year ended June 30, 2016. Market return was a net negative of 10 million. We expect the fund to earn at the assumed rate of 7.25%, and the dollar amount is about $31.9 or $32 million. So relative to the expectation, we fell short by about 42 million. We have recognized 20% of that amount, so that's why we have deferred unrecognized losses for that 1 year of $33 million. So if you now look at the chart at the bottom of this page, if we take into account the recognition of one fifth or 20% of those investment losses from 2016, the investment losses from 2015, the investment gains from 2014, and the investment gain from 2013, and put that all together, the net number is for 2017. We still have a little bit of a cushion because we have not yet recognized all the investment gains from 2014 and 2013. So we are only recognizing a gain of 214,000. But after that date, unless the market turns around, and hopefully the market will continue to remain strong based on the calendar report, but otherwise, we are looking at recognition of losses after the 2017 valuation in the amount of about 4.3 million in the year 2018, 12 million losses of 2019, and then losses of 8 million in 2020. So we have 1 more year of gain, otherwise, unless the market rebound, otherwise we have losses. Okay. So last but not least, I'd like to just touch on the amortization schedule that I promised I said I would go through. So I'm looking at starting on page 47. So now I'm looking at section 3, exhibit J. So for the funding of the plan, we actually keep track of how much unfunded liability we have for each and every one of our 3 membership types. So we start with general, followed by safety, followed by probation. There's a net total that we have developed for the plan as a whole, which is provided on page 48. I think the only comment that I want to make to circle back to my earlier comment on the negative amortization is, if we look at the amortization bases that have been combined and was established as part of the June 30, 2012 valuation, we at one time that basis was amortized over 30 years. It became 27 years in the 2012 valuation. It has continued to come down, and is now we have 23 years left in that amortization period. However, even though payments have been made by the employer to pay off the unfunded liability contribution rate that your actuary Segal recommend to the board, that you recommend to the Board of Supervisors, but notice that the outstanding balance of that unfunded liability is greater, is $133 million on top of page 48, is greater than the 126 million, which is the initial amount. And the reason why this is greater is because the interest that is being charged on the initial amount is greater than payment that is being made by the county due to the relatively long amortization period. However, because of the study, the review of the funding policy, and because of the action taken by the board to reduce the amortization period to no greater than 18 years, you notice that for 2016, we're starting with the 18-year amortization period is 2.4 million. Because we haven't paid anything yet, so that's why the outstanding balance is the same. But if you notice, for the year before, for the experience loss that was established as part of the 2015 valuation, whereas it was originally set at 18 years, whereas the original payment amount, the initial amount was 1.4 million, 1.49. But after making one payment, one year payment, even though it has not gone down by a lot, but nonetheless it has dropped from 1.491 to 1.484. So what we expect to happen is, when we provide you with this report next year, we expect to make a bigger dent on that original unfunded liability. And again, every dollar that is being paid is used first to pay down the interest, and that's still the lion's share of that amount, but we are now chipping into the principal. So that's the reason why there's a small reduction, nonetheless a reduction relative to the relatively long amortization period from 2012. So I think with that, Mr. Chairman, that conclude my prepared remarks.
Any public comment? All right, Mr. Stevens?
Andy, will you explain, if we make a mistake, and as we have on a continual basis, and lowball our contributions, it would have been split somewhat 50-50 going into it with the contribution rate. I want to go to your memo because I saw something in there I never understood before about the continuance being paid by the employer, not being shared with the cost of employee. So I'm a little bit, I'm less comfortable saying what I'm saying now than I was when I thought I knew how it was paid. But basically, the cost is pretty much 50-50. When we go and we set these rates, the forward cost, not any mistake in the past, but it's pretty much 50-50. Is that correct?
Mr. Stevens.
Except for probation and those kind of things.
Yeah, that is actually only true for our newer CalPEPR tiers. CalPEPR, as you know, stands for California Public Employees Pension Reform Act of 2013.
Pretty much 60-40 at least, right? If you say overall. I know we have probation where the county pays the side, and there's some other things like this continuance for the unmodified that we'll talk about. But basically, for prospectively looking out, driving out down the road, looking out the front window, the employer puts in about half and the employee puts in about half, and it's a shared expense for a pension. Is that correct?
That's
Pretty much correct.
generally
Not
true.
exactly, but
Yeah, no.
the general philosophy is correct.
That's right.
If there's a mistake, it gets 100% picked up by the county, right? So anything that's lowballed, will you explain what happens?
Yeah,
If we miss what we have shown in our triennial experience and based our rates on, when we've adopted a contribution rate like today, and when I just said, the debt we added the last 3 years, each year has been a very substantial amount, millions. Who has to pay that? Does the employee have any responsibility to pay for that mistake?
Yeah,
Please let him speak.
Yeah, before I answer the question, I'd like to clarify, at least from my perspective, there's no mistake. The contribution rates have been calculated based on assumptions that are recommended by the actuary that the board approved. Based on those assumptions, that's how the contribution rates have been calculated. And this has happened all the time. I know that this is one of the recommendations from your administrator to do an audit, and I welcome that. I really do think that you should do an audit to be sure that this is really not a mistake. Now, two actuaries can definitely disagree on what assumptions you use to project this uncertain future. So that I think is a given. I don't think that I think it's a case for hopefully for your community that you provide service, Mr. Stevens. Put two investment consultants in the room. I don't know if they would agree, or inflation is going to be this much for the next 10 years, let alone the next.
That wasn't my question. My question is who pays for the mistake?
My point is, there's no mistake. I need to
If
define what is
experience
mistake.
proves to be different than what we anticipated and based our contribution on, who has to pick up that expense?
Thank you for the clarification. Now I can answer
That's
that
why I was
question.
trying to
Yeah, I was
explain it
not
to you.
saying that because I do not see a mistake, but I can see experience being deviant from the expectation. So I can answer the question. Now let me answer that with two examples. In the case of investment return, because we did not earn the assumed rate like we did not earn last year, that would increase the unfunded liability of the plan, and that would be the responsibility of the employer. The employees would not share in that retrospective look at the real review. On the other hand, I would also like to balance this conversation by saying that during the last 5 years, one of the biggest deviations, I won't call it a mistake, has been overstatement of the salary increase assumption. So we have salary gains for the last 5 years, except this year. In that case, you can argue that looking at the real mirror, the employees have been charged a little bit more according to the assumptions. So I want to be sure that the employees don't get any of the benefit of the liability coming in, at least with respect to the salary assumption. They don't get the benefit of their rate being reduced prospectively. because any increase in the unfunded liability in the case of the investment return assumption, or decrease in the unfunded liability in the case of the salary increase assumption, is the employer's responsibility. And that is the case in this plan, and it's also the case at the other county retirement plan. And I think, as a matter of fact, this is one way I'm willing to put my reputation on the line. This is the case how contribution rates are set in the 32nd Act community. Any unfunded liability, with very few exceptions, are paid for by the employer.
But
Mr.
when you
Knudsen.
have- when you have the unfunded liability go up so much substantially every year, it has to dwarf any savings or experience gains, right? Otherwise, the unfunded liability wouldn't go up.
Mr. Knudsen.
Yeah, maybe clarification, you're saying the contribution is split between the employer and the employee. I think under PEPRA, the employees are required to pay 50% of what the county pays, so it's not, they're each paying 50%. Right. It's more like 1/3 to 2/3. But the one thing I wanted to clarify is when earlier you were talking about using excess earnings to pay for health insurance, and that it's a decision of this board, it was done at the direction of the Board of Supervisors. And I reported to them every year what was going on, how much money we had to pay for health insurance. In fact, in September of 1998, when I made a report to them, they passed a resolution that said, no one who starts working for the county after September of '98 will have health insurance when they retire. We kept keeping the Board of Supervisors informed, and probably twice a year, they voted to authorize us to use our excess earnings to pay for health insurance. It wasn't done by this board, it was done by the Board of Supervisors.
Mr. Drury.
So can I drop you page 53? Not sure about you, Tim, but I suspect that board action was taken after a recommendation from longtime county staff.
Yeah, from a long time ago.
County staff probably recommended that action by the board of supervisors, but
We told them what the deal, what the circumstances was, and they made their decision.
okay, so on page 53, it has the total normal cost for this year, and at just under $13 million, the employee contribution of 5.9, and then the employer cost of 6.8. And so this is basically, in part, the driver here is the assumed rate of return is 7.25. So just looking at these, at the normal contributions, and I know this is, we're mixing some apples and oranges here, and that there's several different bargaining groups, different plans. Public employees with more than 30 years service aren't paying any into this plan. But in general, what would those numbers look like if the assumed rate of return for this year was 6.25 instead of 7.25?
I don't have the answer.
I would request that we have that information prior to this going to the Board of Supervisors, so they would know what it would be, what it would look like.
Now, the only, through the chair, the only time we quantify the impact of a lower investment return assumption was at the time of the 2014 triennial experience study. I remember at the time, the impact of the contribution rate impact as a result of our Segal's recommendation to go from the 7.75% investment return assumption to 7.25 was very significant. So the question was raised, so what is the contribution rate impact? But it was only 50 basis points. I'd say in air quotes, only 50 basis points. I do remember for the plan as a whole, not just the normal cost rate for the employee, but the cost for the plan as a whole, as well as any unfunded liability that results. Because remember, no good deeds will go unpunished. Anytime we make the assumption more conservative, increase in unfunded liability. I do remember that 50 basis points has resulted in a 6% contribution rate impact. So that is not just this number that you're looking for, which is the normal cost rate, but there's normal cost rate plus unfunded liability. And it was for a 50 basis points reduction based on the conditions at the time when we did the 2014 experience study. So it was 6% contribution rate impact as a result of the reduction that we recommend to go from 7.75 to 7.
So all things being equal, would a 1% logically then be a 12%?
I think it would be higher.
More than 12?
Yeah.
But how would it be spread? Because the normal cost would be spread roughly equal, but the unfunded liability
About a
would go.
quarter, 3/4. quarter, 3/4.
Mr. Sackler.
Thank you, Mr. Chairman. So this is to legal counsel. This is a question about the Pepper law. So we've been talking about what the contribution rates for employees covered under Pepper would be. So for the impact of future contribution requirements differing from those in the valuation because of a shortfall created from actual experience versus anticipated experience. Is it true that the split would be 50-50 between plan sponsor and employee? Is that in the Pepper law?
No, if you're talking about the normal cost, it's a 50-50
Zip.
split
Okay.
for the normal cost.
For the
not-
normal.
Not figuring in whether you would hit your mark or not.
With a percent cap. 50-50 with a percent cap, right?
I think that's right.
There's a percent cap in it.
Mr. Stevens.
Yeah, so, I just want to say that excess earnings, I wasn't talking about what we did in excess earnings. I was only looking at it in the context of whether it was clear inside the recommended rates that we were using this practice. And it was built into the rates, which it wasn't. That's the only point I was making. So my question is, if we really did have a lower rate than we expected, so we're saying, oh boy, the cost would go up really high if we lowered the target rates, the contributions would go up because they're inversely related, kind of like bonds we were talking about today. If we had good authority that the rate was really going to be realized at a much lower rate, the rate is what it is. So we can say, well, let's don't reduce it because it'll be too expensive, but we're going to pay it. We're just going to pay it over 18 years, isn't that correct? We must pay it if that's the rate. We just are adding to the debt and pay it off, amortize it over 18 years. And the employer pays 100% of it. The employee pays none of the rate differential.
Through the chair, I remember, even though it was almost 3 years ago, when we recommend the investment return assumption, we definitely put forward the contribution rate impact. I think that was one of the considerations by the board at that time. I don't think that was the only consideration. I think the board has a lot of checks and balances that you have to take into account. I think the affordability of the employer to pay is one, but I don't think that was the only issue on the table at that time.
No, my point was that if, let's say our investment counselor came in today and said, you know what, in the last 10 years, you've only gotten 6%, and you have a 40 basis point load for administration and investment expense, so really you've only realized 5.6%. And recommending and looking out the front window, we only see how you can get, because of what's happening in bonds, what's happening in growth and the economy and how it relates to stocks. We only see that it's realistic to expect a 6.6% rate of return. And oh, by the way, you have to take out your investment expense and your administration expense, so it brings it to about 6.2. If we believed that investment advisor, and even if we looked at our actuary, and our actuary report said what our rear 10-year was, it was about the same. We'd have to lower our target rate about 150 basis points if we looked at our actuary in their latest report that we're looking at today. If we believed all that, and we said, you know what, we're not going to do it because it's going to be too expensive. It's going to be not only, you can't change the rate of return. You're going to have the expense. You're just going to have the expense 18 years with interest, and the employer picks up 100% of it, and the employees pick up none of it. Isn't that correct?
I think I sat through the entire conversation, discussion with your investment advisor. The one thing that I pick up on is investing at this time, triple time, no like any other time period we have in the past. I think when we look at the report, it is our report, right? Remember, we said during the last 10 years, rate of return was on a market value basis of 5.59. The only word of caution I have, whereas I respect your input and opinion, Mr. Stevens, but as they always said in investment, past performance is no guarantee of future. Future may be higher, future may be lower. That's something I don't know. Now, the only other point I want to put in is, I know that there's some differences between how the investment consultants set the target rate of return, but bear in mind though, when you hire Calvin, and Calvin is not in the room, but I would be willing to say that in front of them because we are trusted partners in other jurisdictions. You're really hiring them to come up with a assets allocation decision. But when you hire Segal, you're hiring Segal, and that's usually something that you can reasonably rely on as a decision for the next 5, 10 years. Even though every year, I think I have been in front of this board, they always come in at about this time of the year, they always say, oh, let's take a look at the rate of return, and maybe there's some need to at least consider tweaking the returns going forward, and that's why you ask them to do an assets allocation study every so often. On the other hand, when you ask Segal, well, recommend an investment return assumption, which we did, and back in year 2010, when we first showed up as your consultant, return was 8%. We were not afraid to recommend, the board was not afraid back then to reduce the investment return assumption from 8 to 7.75. We did that again in 2014. You took our recommendation, reduced that from 7.75 to 7.25. Now, we don't know what we're going to recommend, quite honestly, when we show up again next year. But definitely, if you ask Segal, what is the trend in the market, as far as not what the investment consultants have brought to their boards whenever they go through the
Andy,
assets
this isn't the
allocation.
question I asked you.
Yeah, I'm getting to it.
Let him finish.
So I think the trend of the industry is reduced investment return assumption. So with that as a backdrop, if we were to remeasure the liability next time with that lower assumption, I don't know what it is, well, you take a number, 7% or whatever, is that going to increase the unfunded liability? The answer is yes. So that actually is evidence in the 2 experience study that we did. So that's the reason why I said, I go back to my point that no good deeds will go unpunished. Anytime we recommend that the board approve the more conservative assumptions, it's going to increase the unfunded liability.
So my question was, I'm going to restate it. If this board adopts a rate that we know is way below what our investment advisor is recommending we should expect for a long-term rate of return, and we do that, and it comes true, as everything else pretty much has come true. I mean, you can say that we went down and no good deed goes unpunished, but we should have gone down a lot more, because just in that 3 years, we have $80 million of additional debt, which is unbelievable. But my question was, so if we lowball the rate again, meaning we keep the contribution rates lowballed and keep the target rate unrealistically high today in inaction, and what our investment advisor predicts is accurate, and we miss again like we have every year, our unfunded liabilities continue to going up every year, who will pay that cost? We have to pay the cost, right? And it'll be paid over 18 years with interest by your schedules, right? So if we believed our investment advisor, it's not like we can change the numbers from actuality. When they said 4 years ago that their expectation was 6.6, and hey, in the next few years we see it really bad, and we didn't pay any attention to them, we reduced it a little bit, not what we should. We have debt that has shifted from a shared expense to expense solely at the responsibility of taxpayers and user of county services, that is being paid back that same dollar amount that should have been shared by the employees, and is paid back with interest over 18 years. Isn't that exactly what your schedule showed?
Mm-hmm. Yep.
Thank you.
Ms. Shatmeyer?
I have a question. I just want to make sure I understood what Supervisor Jurdy was asking. So did you say that if we lowered the assumption by 0.5%, that our cost, the plan sponsor, the cost would go up 6%? Is that what you said? So instead of like $20 million, or almost 20 million, we'd add like another $1.2 million
Yeah,
to that.
The 6% of payroll is the share cost. I don't have in front of me how much of that would be paid for by the employer, and to Mr. Stevens' point, some of that would be picked up by the employee.
Okay.
But I know that at the time when we did the analysis back in 2014, 6% was the total increase in cost. Some of that would be paid for by the employer, most of that would be paid for by the employer, some of that would still be paid for by the employee.
Okay, and the reason I'm asking is because right now we have $3.65 million in a pension gap fund at the county. So clearly the county is prepared to pay more towards this. And I mean, how can that work in this process? I mean, how can we take the benefit of that money and actually get it in here and actually use it to where it's better for everybody?
Now, at least at the moment, and so that's why I want to go back to the process. So my understanding is, based on the process and procedure that's been followed by the board, you only look at and revise your actuarial assumptions every 3 years. So this is not the valuation that we'll be revising or reviewing those assumptions. But definitely, I'm glad to hear that the county has a reserve built up, because if there were to be any change in the assumptions, and I think and if there were to be one, it would be to lower the investment return assumption. I don't think we would ever recommend, and the board would never agree to increasing the assumptions. So let's be upfront about that. I think that money can be used to pay down or to at least be hold as an item on your budget to offset or to mitigate to some degree the contribution rate impact that would result as a result of those recommended decrease in the investment return assumption, if that were to be the case in the next valuation. But until then, I caution the board to second guess the assumption, because after all, it was approved by the board. It was not unanimous, but it was approved by the board only 2 years ago.
Mr. Dirty.
So the reason why I'm asking that this information be provided to the supervisors prior to their voting on this is because the supervisors, county will be in the process very soon of negotiating contracts with all the bargaining groups. And they need to know, because I think it is highly likely that they will be needing to vote to reduce the assumed rate of return in the next actuarial study. We need to know before we sign any contracts with the employee groups what we need to be contributing, and the employees will need to be contributing into this plan with a reduced assumed rate of return. If we instead don't have that information and go and sign a bunch of contracts, we'll be putting both the employees and the county in a bad financial situation, because we'll be making decisions in a vacuum.
Through the chair, the only reason, don't get me wrong, we are not resisting providing that information. The only reason why I said what I said was I don't have the information in front of me. But definitely at the direction of the board, we would be more than happy to provide to you, perhaps for every, so let's say 25 basis points or 50 basis points reduction in the investment return assumption, what that contribution rate impact would be for the employer and employee. We certainly can do that number, can generate that number for the board at your direction.
Mr. Stevens.
As our actuary, as our paid professional here, do you know what the term moral hazard means, and can you explain it in the context of the 37 Act?
Generally speaking, whenever a question is raised, so what would an impact of I would use investment return assumption as an example. What would be the impact of a reduction in the investment return assumption be on the contribution rate requirement for the employer and employee? So the question can be raised by the employer, in which case the employer is being cautious. The question can be raised by the bargaining parties, because we know that there are only so many dollars to share around at the bargaining table. And so to the extent that money needs to be set aside to provide for pension benefits, then the dollars will not be available to pay for salary increases. So the term would mean that any time somebody asks the question, maybe they already know what the answer is going to be and what the action is going to be. Now, I would submit to you, Mr. Stevens, that whenever we answer this question, because we are truly independent, we serve at your discretion, at your pleasure, and for that reason, I would advise just to the board. We never sat in front of the bargaining table, we never sat in front of the employer, we never sat in front of the bargaining table. So I think that and I think our records speak volume. We are the actuary for 12 systems, and we would not have, I personally would not have been your actuary and the actuary for the other system for 30 years if I offer you bias and partial input.
Thank you. With all due respect, looking at actuaries and what they've done to financing pensions in a safe and sound way has been, you can't say very many good words about it. Let's put it that way. And so if you'd come back and said, you know, Ted, we have 11 other people and 50% of them are overfunded, or, you know, it averages out they're all funded, I'd have a lot greater credibility, but I know they're all underfunded. This is a terrible situation. The people that are working in this county and putting their money in the plan and the employers matching it, those dollars never go to the plan, they go out. a third of our expected earnings. Everybody goes to the pension college and they say earnings is what makes the plan. It does 99%. Well, we're siphoning a third of the earnings off now. It's not excess earnings, but it's to pay current benefit payroll and administration expense. I see this plan continuing to drop. We've had a market recovery that is unbelievable. Our investment managers are saying we shouldn't have the same expectations going forward that we've had historically for rates of return. And I see a reluctance that I can't believe to do what this board's job is to make sure this plan is fully funded. The funding is continuing to deteriorate. Every year, this year $40 million, last year $24 million, the year before $15 million. It's continuing to deteriorate. Our unfunded liability is skyrocketing. You can say, well, you know, part of that's because you changed the contribution rate. We changed the contribution rate only a half to a third of what we should, and it's because it's a real rate of return. And because we didn't change it to what we should have, if we'd really been doing our job, we've added all this different debt. So if our investment manager was said, happy days are here again, I don't have any problem with a 7.25% target rate, but they didn't. They said 6.6 before you take out your admin and investment expense, which brings it to 6.2. They also said that if you look at real GDP growth and you look at inflation over the next 30 years, it's 2.25% is what's being predicted. For this board to say, oh, you know, 7.25 is cool, because I'm smirking because I know there's some moral hazard here. Everybody in government wants the taxpayers and users of services to pay their bill. It really, you should recuse yourself with the dismal performance, creating all this debt. Anybody around this table that has a vested interest in lowballing the rates should, I think, shouldn't. One thing, if we'd been 50-50 right, I can hear your deal, but look at, we've wiped out all our net worth for 166 years, and we have another 64 million that hasn't even hit that statement yet. It'll be 150% of our net worth we wiped out. And Dr. Wilbanks, thank you for telling us how you think this thing's funded, but the funding is right on this board. No one else has responsibility. They can set benefits, amen, brother, but we set the rates. And if we know the rates are making this plan go down to 67.5%, you don't see private plans out there that haven't cut benefits, that haven't mandatorily, by government action, been forced to reduce benefits. And if we go, oh, you know, it'll get better, let's keep the rate, contribution rate high, and they'll pay for it. We're not doing our fiduciary job. So I'm going to make a recommendation right now that we reduce our target. We send Segal back to recreate the contribution rates at with a target rate of 6.25%. It's all we can justify in the looking out the front window with what our investment counselor said today. There's no way we can justify it looking out the back window in the rearview mirror for the last 10 years, even when you exclude, as I am, not including excess earnings. It'd even be worse train wreck if we did that. But you'd have to reduce it 150 basis points, 175 basis points if you looked in the rearview mirror. But looking what Talon's saying, only prospectively, we should reduce it 100 basis points, a full 1%. Send Segal back, bring him in the next meeting, and let's look at it. We have plenty of time to make a decision at that time whether we should adopt what they've recommended here, or whether we should adopt it at the 6.25 target rate. That way, we'll be able to make a recommendation, and the Board of Supervisors will have it on their desk that we did our work as far as funding. You know, when we go reduce it to the target rate of interest, we're not even taking into all these other things. And even though you say there are some gains because we haven't had salaries increase as much, the reality when I look at it, and again, I'm not an actuary, but I do have pretty strong financial credentials, been doing this rodeo for a long time. The money that's coming out of this plan from benefits, I don't think we're accurately predicting what benefits are. And so if we reduce, I'm saying there are 1,000 cuts hitting us. One that we do see from what we heard today from our investment counselors, reduce the target rate, and then in our triennial experience, we'll look at the rest of it. But as a fiduciary, I don't see how we can do anything else, because we know the rates are what they are, and if we delay this action, it must go to the debt, And when it goes to the debt, the sponsor picks up 100%, not only of the debt, but the interest on the debt at 7.25%.
I'll second the motion.
Hold on, he didn't make a motion, Mr. Wilbanks.
I did make a
You
motion.
did, you made a recommendation. Mr. Wilbanks.
To the matter of what our rate of return should or should not be. All we have is opinions. There are no facts. And I sit here and I consistently hear what Segal's projections are referred to as a fact. They are projections, they are estimates, they are an educated guess. There are no facts in terms of what will happen in the future. We know there are differences in the methodology used by Segal versus the methodology used by Callan. The most significant difference in the methodology being the assumed inflation rate. I think, the board has a policy by which we review, or a practice, I should say, by which we review our experiences every 3 years. This is a multi-generational prospect here. And we do things very methodically. We all sat together a year ago and talked about this being a policy-focused governance board, focusing on governance, focusing on the long term. And I would caution you that needs to continue to be our focus, is on the long term. So,
Mr. Knudsen.
Yeah, as Billy Bear would say, this is deja vu all over again, because I remember sitting here last year and having this exact same discussion, and I seem to remember Paul Angelo saying something like, if you don't take your actuarial advice from your investment consultant, I promise you I won't tell you how to invest your money. Period. And I felt, just a minute, Ted, you've talked for probably 3 times longer than anybody else. I think we need to move on with this. We have an actuary, as Dr. Wilbanks says, they do their best projections based on how things stand on one given day, and they give us a recommendation, and we have our choice to vote on that, or then we send it on to the Board of Supervisors. The Board of Supervisors can change that. They don't have to take our recommendation. If they want to raise it up and increase the rate, they got all the right in the world to do it. I am going to believe the actuary, not believe the actuaries, I'm going to take their estimate of what they think the rates are going to be, and I'm going to stick with that. So
You can make a motion, Mr. Knudsen?
I move we adopt the actuarial report and the rates as recommended by the actuary.
So we have 2 motions on the table.
No, we don't have
No,
any,
that was a
Mr.
recommendation.
Stevens didn't make a motion, he made a recommendation.
I thought I made a motion.
You
My
didn't say a
intent was to
motion, you
make a
said
motion.
recommendation. Do I have a second on Mr. Knudsen?
Oh,
I'll second it.
I'd like to offer an amendment to the motion.
Sure.
To ask, direct Segal to bring back at our next meeting figures that would show revised assumed rate of return of 6.25, and the payments based on that.
The maker of the motion doesn't agree with that.
Well, I'm offering an amendment to your motion, if there's a second to my amendment.
He just wants let me just clarify, he wants to have an addendum where they come back, and so for the purpose of the Board of Supervisors, so they can see what it would be at 6.25%.
I'll second that. Except for that piece.
Well, that we got, Mr. Knudsen is the maker of the motion, do you want to amend that, or?
I don't want to accept what he's saying.
Okay.
I say we set our we always agreed, every 3 years we set our estimates, and I don't see change in it, right in the middle of we got 1 more year, and we'll make that recommendation in 1 year.
Okay, so we have a motion, and we have a second, so we have some discussion.
There's an amendment that's been, a motion to amend.
We have a motion and a second that hasn't been amended.
I made a motion to offer an amendment, it's been seconded by Jerry, and so that gets voted on prior to the.
Okay.
the
So Jerry, you got a second on it?
I did, and my reasoning is, I don't think it hurts us to be able to have all the facts and figures. We have a very careful, methodical way of going through our rates of return, our recommendations to the board. I want to commend you, Andy. I've been exposed to other actuaries. I think you do an outstanding job.
And I think it does not in any way compromise our decisions to have additional information, because we're dealing with what happened in 2008 and 2009. Looking at all our public plans, and instead of painting everybody with this broad brush that says we've screwed up royally, what we're doing is trying to deal with an unprecedented recession. Not a regular one, but one that took all kinds of plans that were fully funded and took their funded situation down considerably. I'd like to know in backing what Dan has asked, with contracting coming up, with messages to employees and unions about what it takes to maintain a decent, defined benefit pension plan. We need to have a pretty good idea, not of the future, but what information the board should have based on our recommendation. So I'd like to see you bring that information back.
Dr. Wilbanks?
I want to caution the board that we are moving away from trying to be a policy-focused governance board with this amendment. Because just sitting here, I have a myriad of questions.
Okay.
If we're going to bring some rates based on changing one number, well, that's one issue. But thinking through Segal's methodology, we have to ask the question, if we're lowering the assumed rate of return from 7.25 to 6.25, how are we doing that? Are we just assuming a lower real rate of return, or are we also adjusting our assumed inflation rate with Segal? Because the differences there are very, very material. Your advisors, Segal and staff, have not considered this amendment, if you will, and thought through all of the actions and reactions that we would need to consider in order to bring you a recommendation as to what is reasonable. So I would caution you that this is moving away from the policy focus and more towards the operational side of things, where this board is making on-the-spot decisions without thinking through all of the impacts and secondary impacts there. So,
Andy?
Yeah, thank you, Mr. Chairman. Yeah, I would want to repeat the same, rather than repeat all the same points that Dr. Wilbanks has made. I agree totally. As a matter of fact, it would be one thing to come back to the board with an informational item. If you were to ask Segal, don't change anything, but just focus on interest rate, we can come back with an item.
That was what I thought I was asking for.
So we can do that. But Dr. Goodman is quite right that when we come back to you next year at the regular triennial experience study, we would not be just looking at interest rate, we'll be looking at everything. We're looking at interest rate, and by the way, under Segal's watch, the inflation assumption has also come way down, because before we took over, the inflation assumption was 4%, we took it down to 3.75 and 3.25. So I think we have a track record to not be afraid to make the recommendation to the board, and the board has a track record to not afraid to take Segal's recommendation. So I think by looking at one assumption, I can see you're looking at the sensitivity. Perhaps we're not saying that this is what is going to happen in the next study. I want to be absolutely clear, even though I respect and I acknowledge that your investment consultant has come back with a 6% or 6.6% assumption, but that's not what necessarily Segal would use to base our investment return recommendation at the next study, because we truly have not even begun to work on that study. It's not until next year. But we can certainly bring back for an informational item, because we want to study the sensitivity, and we have been asked by other systems to do the same thing. So I'm not opposed to that, but we're not expecting, unless I hear you correctly, we're not expecting to bring back another pool binder with Segal's name on it, and every contribution rate recalculated using 6.75 or whatever the assumption is. That's not what I think we would be wanting to do.
Mr. Chairman, That's not, I'm asking for an informational item. I am not advocating taking out of, our normal policies as determining rate of return or whatever. I'm just asking for something that will help to share with, county employees out there. The fact that times are changing. We had to deal with the recession, Great Recession, as far as the impact on everyone. But this piece of information, I think, could be useful and might be helpful in negotiating contracts, whatever. And the recommendation would come from this board. I don't wanna take it out of sequence. I would just like to know.
Mr. Jordan?
Just concurring with Jerry, that I think I realize we're talking about it's sort of a proxy number. We're not looking at a number that you're anticipating would be identical or precisely what you would recommend when you do the comprehensive triennial study. So this number would be providing information to the public, to the board, to the employees that could be used, in my mind, as a proxy for information as they negotiate contracts.
Could we just turn this more into a direction to staff to work with Segal to come back with some information related to that, or do you want to add that to the motion?
Well, if the board, through the chair, the board wants to give direction to staff to provide that information.
I'd be happy with that.
So everybody agree, give direction to staff to work with Segal to come back with something that works for Dan and the board?
So not adopt this today?
Well, no, I'm not saying, no, we can adopt this today, but
Okay, so then I'll withdraw a motion, Jerry's.
Yep.
You have to withdraw your motion.
No, he doesn't have to withdraw the motion. Dan would withdraw his motion, and work with, staff will work with Segal to come up with something that meets, Mr. Jurdy's requirements and Jerry. What they,
So,
hold on, I mean, is that okay?
Yeah,
Okay.
yes, with me.
Okay, so do we have direction for staff? Okay.
So just to clarify, direction to staff is to work with Segal to bring an informational item back to the board that looks at a different rate of return assumption and a different inflation assumption, lowering each of those by 100 basis points? Is that what the intent is, or is it some other intent? I need to be very, very clear on what it is in my direction is.
Well, maybe not limit to one option, but a couple options there.
Like maybe
Half
50
and
basis
maybe one.
points,
Okay.
100 basis points.
50 and 100.
Yeah.
Yeah.
Okay, so, and pairing, the part I need to be very, very clear about is pairing the inflation assumption reduction with the rate of return assumption reduction. Is that the intent of the board?
well,
Are you making this more complicated than it needs to be?
Yeah, I think we are.
Instead of
Yeah, I think we have
7.25,
to-
you wanna know what it is, it's
6.25.
6.75 and 6.25, right?
Exactly.
Isn't that what you wanna know?
Yeah.
Dan?
But
Yeah.
what I need to know is, are you also reducing the inflation rate?
No, I think he just,
Or-
We're not
Just,
reducing anything.
just the rate of return. I think that's all they want, right?
So
I think
leave
you
the
make it more
inflation
clear.
rate where it is.
Yeah, leave all the other assumptions the way they are, just adjust the rate
That's
of
the
return.
bottom line.
Yeah.
Is that what you-
so I have a point of information.
Mr.
I've
Sackler?
had my hand up forever.
So, thank you. Thank you, Mr. Chairman. It's a point of information. I noticed that Chief Deputy CEO Alan Flores in the room, and of course, Supervisor Jurdy. I'd like to ask whether either Segal or Dr. Wilbanks will be on the agenda at the Board of Supervisors anytime in the near future, speaking to the issue of contribution requirements as the county goes into labor negotiations.
So,
Hold it, John, you're getting off topic here, let's get back to this, what we're talking about, all right? All right, so, you have the information you need to go forward?
yes.
Okay, okay, so we have a recommendation from the board to to Dr. Wilbanks to work with Segal to come back with something for the Board of Supervisors to review and making their decision. And if you have any more clarification for it.
Board of Supervisors or for this meeting?
Well, for next meeting, they're gonna bring it back, but it's mainly a point of information for us and then for the Board of Supervisors to use it.
And are we gonna put off adopting rates till we've seen that?
I don't think so. I mean, we have a motion on the table to adopt this, unless we wanna rescind it or vote it down. I don't see, we're not rescinding it.
Well, the reason I asked my question, Mr. Chairman, is because I'm wondering how the results of that informational study will be communicated to the Board of Supes.
Well, it'll come through MCERA next meeting, and then it's public information after that, so however they wanna use it.
I think they actually.
They will be.
Mr. Stevens.
Well, maybe that's why our administrator was confused earlier when he said that we don't have responsibility to adopt the rates or the funding of the plan. We do. If we do this kind of conflicted deal where we go give the board other rates without doing our job, I don't think we've done our job. The responsibility for making a recommendation on the rate rests with this board. I think we should do that. I think we have plenty of time. If we put it off to the next meeting, this board looks at it, looks at the funding of the plan, and makes a recommendation on what the employer should adopt at that time, after we've seen these numbers. I think that's the correct way to do it. It's the way a board should work in this case for an association like this, to recommend for the sponsor. And as Segal, all due respect, I appreciate Dirk, Andy, you guys coming and hearing what you have to say, but I have to look at it from the first do no harm. So I hear that, they've done a great job and the market, what did bad. All my clients are 100% whole, they have been for a long time. We aren't. The unfunded liabilities doubled since I've been here. It appears as though, I don't have any real faith in this actuarial stuff, because it's always that if you flip the coin and it's head, the employees win, and if it's tails, the taxpayers and users of county services lose. It's the way it's been repeatedly. Whenever I looked at it and go back to 96 and 2002, the pension obligation bonds, we didn't have pension obligation bonds because the actuary was predicting the cost of this plan correctly. And it appears to me, from my analogy, it's like, when I said first do no harm, I'm thinking of the early doctors. They used to bleed people, and if we're getting sicker, and we're talking about doing some more bleeding. It's clearly what we need to do here is put more money in the plan. And if we kick the can down the road, we even need to put more money in, and we're assuming we're gonna make 7 1/4 on the money we're gonna put in later, and we're not. It's even gonna be more yet.
Okay,
It's terrible.
Let's stay on the motion, okay? I'm not taking we have a motion on the table, so I'm not taking public comment. You had your chance. I asked before a motion was made if there was public comment. Nobody.
No.
After the, yeah, I did.
You didn't.
Yes, I did ask if there was public
Not
comment.
after the discussion.
I just quickly, if we're gonna do this, have staff get together with the actuary to show us what the rates would be at 6 1/4 or whatever, pick a number, you're picking a number out of the air. I'd like to have the actuary say whether they have any idea whether the number we're asking them to use is a good number or not. You're following?
So you're saying
So-
wait?
No, not wait.
Oh.
Go ahead and do it.
Yeah.
Whatever number they have, but I would like the actuary to say, we believe this is a good number for you to use, or we don't believe it is because this is why we don't think you should use that number. I don't think we should be telling our actuaries how to do their report for us.
Sure.
I just wondered what Jeff's thoughts were on this, as far as this is our actuary and a fiduciary responsibility as far as to, I mean, maybe because it's lower, do you have any concerns with what you're hearing here?
No, I mean,
Okay.
if I'm understanding it correctly, you're gonna decide on whether or not to approve the contribution rate. Separately from that, so it may be providing informational assistance to the Board of Supes, you just want a number calculated. And so if we didn't have 7.25, but we had 6.75, what would those numbers look like? Or if you had 6.25, I don't see any problems with that at all.
Okay.
Unless I'm missing something, but I don't think I am.
Yeah.
Thank you, Mr. Chairman. I want to reiterate the point that Jeff made. This is purely informational item. We're not recommending that the board deviate from your current process policy, which is to not adopt any assumptions until and unless you go through a rigorous triennial experience study. I think we are always at your disposal to give you answer the what if question. As a matter of fact, in our GASB 67 report, which is not up for discussion right now, there's already a sensitivity on how big or how small the internal liability would be. It's called the net pension liability. If there were to be a 100 basis points either reduction or increase in the investment return assumption. So that information is already in the books. That's required by governmental accounting standard board. We express no opinion because it's required. So I can see this as being one of those informational items, but I want to emphasize that we're not, by agreeing at your direction to give you these numbers for informational purposes, we're not making a recommendation. We do not know, and let me emphasize again, fourth time, we do not know what our recommendation is going to be to this board on investment return assumption, among others.
Mr. Chairman, if I might, the decision to change contribution rates, the decision to look at rate of return, the decision to listen to, or maybe not a decision, to Callan, who is also predicting what the future might bring. I believe our policy decisions have to be carefully made, thoughtfully, and advance notice. Again, taking the position I held before, we are just CalSTRS is slowly increasing rates, contribution rates. Not this, today we're gonna make a recommendation and things change next month. But advance notice to employees and to the community that things aren't as we would like them to be. Things are not as they were in 2007. It's a different world. Should be thoughtfully done and should give good advance notice. Even though you might have contracts up next month or whatever, employees do deserve a right to have notice, not a change in their paycheck coming next month. So that's where I come from.
I'll do 2 public comment. Mr. Anderson, and keep it on topic.
Oh, it will be very on topic.
Okay.
The recommendation, according to the National Society of Actuaries, or whatever their formal national body is called, is 6.6%. That's all you need to say.
All right. Thank you very much, Mr. Anderson. Mr. Dickerson.
I've been looking at this for over 10 years, and I have data. There's 21 county pension funds in California, 20 organized under the County Employment Retirement Law. One, San Luis Obispo, is its own legal creature. But there's 21 county pension funds, and I have data, financial data, going back to about 93, 94, for a few, a little more, few, a little less. And if you look at that entire period of time, and you calculate what there are 3 bull markets and 2 bear markets. And Jerry, incidentally, the Great Recession, as bad as it was, is nowhere near as bad as many of the other depressions in American history, but no bull stock market in American history was longer than the bull market in the 1990s. That was the unique financial event over the last 25 years. And I think that a large part of how bad the 2008 crash was because of the excess bubble that happened in the years before. If you calculate the returns on investment for those 21 counties, simple averages, or do as Dr. Wilbanks did, said, start with $1, what do you got after 25 years? Are you dollar weighted? Every one of those 21 county pension funds, except for one didn't, earn more than its target rate of return. If you look at the big picture formula of pension funding, you have contributions plus investment profits, equal benefits, primarily pensions, and general administrative costs. General administrative cost is a very small part of the whole, so you leave that out for simplicity. Okay, so they all but one earn more than its target rate of return, and they all report they're underfunded over a 25-year period. There's no other conclusion to come to. Mathematically, it means the contributions were too low. And I think I've changed my mind. 10 years ago, the conversation is, and how you're framing this is, what's the return on investment going to be? Well, two things. One, that's not how the number is used in the calculation. It's a discount rate. The first thing the actuary does is project what's going to be paid in the future, and then says, how much do you need today so that if you earn that, you'll be able to pay it, and that's your liability. So it's actually used as a discount rate. To me, the way that you should be thinking about the rational way is that it's not really the rate of your expected return. It's the simplest way a board of directors has to adjust funding expectations based on your history and what you think your projection is going to be. In the Dutch have the gold standard system in the world, in my view. They use 4%. When their target is 105% funding at 4%. When they get into the 90%, when they go below, they have 3 years to get back to full funding. After 2008, they gave them a break. They gave them 5 years. And they talk about the crisis in Dutch pension funds. This pension fund would have been taken over by a state agency 20 years ago if this was the Netherlands. And when it gets into the 90%, they cut pensions. So the main point I'm making here is, after 10 years, I think thinking of it as your projected rate of return, to me, I think is not as realistic as thinking of it as the simplest way the board can adjust the funding formulas for the future so that you can make sure that the pensions are going to get paid.
Thank you, Mr. Dickerson. Okay, we have anything else? Okay, we have a motion to accept Segal's report, and we have a second. Judy, roll call, please.
Ms. Cavanis?
Yes.
Mr. SACRS?
Yes.
Supervisor Jordy?
Yes.
Mr. Stevens?
No.
Mr. Walker?
Yes.
Mr. Knutson?
Yes.
Ms. Harris?
Yes.
Ms. Shatmeyer?
Yes.
Mr. Goodman?
Yes, motion passes. Okay, we need a short break, or we want to move right into, okay, good moving. Move on to number 7, discussion of possible action regarding the June 30th, 2016 Governmental Accounting Standards, GAS.
Are we gonna look
67?
at 67 or the Segal memo?
We're going to do 67 first. Okay, Andy.
Okay, thank you. Good morning again, Mr. Chairman. My name is Andy Young, joined by my partner, Dirk Edmondson. So in front of us is the so-called Governmental Accounting Standard, GAS for short 67 valuation. It provides the bases and results required for completing your financial reporting requirements under the Governmental Accounting Standards Board requirement. So I think for this report, maybe I'll turn over to Dirk and ask him to walk us through and highlight a couple of things, because there are a lot of similarities between the liabilities in this report versus the funding valuation that we have been looking at for the last hour.
I'd like to direct your attention to section 1, Roman numeral 3, triple I, the summary of key evaluation results. You look in the first section, the middle 2016 column. Second item down is total pension liability. This is the same liability that Andy has alluded to in the funding valuation report, $632 million. Next item down is planned fiduciary net position. This is a statement of your assets at market value as required by GASB. That's $426 million. The same figure appears in the funding valuation report as well. The difference between those two numbers is your net pension liability, one of the items that needs to be disclosed on your financial statements. That's $205 million. So you've seen all of those figures before. It's just presented in this report for under GASB requirements.
So a commentary is that for the funding valuation, we continue to use the smooth value of assets, the actuarial value of assets, to compare against the liability. So whereas in this valuation, the liabilities have not changed, it's the same, exact same liabilities, calculated using the exact same method, same assumptions, same everything. Except that GASB says we have to use market value of assets. So in this year's valuation, because market value of assets is lower than the smooth value, so that's why the unfunded liability or the net pension liability in this year's calculation is higher. The opposite would be true for last year's number, because last year, remember I said the market value of assets was about $11 million stronger than the smooth value of assets. So that's why when you compare last year's number against the funded status from last year's funding valuation report, it will show the exact opposite. And one number is bigger than the other, or smaller than the other.
So it says a companion information, if you flip forward to section 2, page 4, there's a similar presentation of the assets and liability, and then there's an expression as a funded ratio of 67.5%. So that's, again, the same 67.5% that Andy was mentioning in the funding report. Had you switched to from smooth market value to straight market value, your funded ratio would be 67%, 67.5%.
So I think last but not least, we alluded to this number is on page 5, the bottom of page 5, because I said early on, as part of the Governmental Accounting Standards Board GASB requirements, we are mandated to study the sensitivity of the liability, not the contribution rate, but the sensitivity of the liability, the total pension liability, the net pension liability, on a 100 basis points change in the investment return assumption. So over there, the mandate was keep every assumption unchanged, but do increase or decrease the current 7.25% assumption by 100 basis points, meaning take that down to 6.25 and see how much that is going to impact the liability, the unfunded liability. In accounting speak, it's called net pension liability, and do the same thing on the opposite end to be more balanced, show what the reduction in the net pension liability would be if we were to increase the discount rate. One leg of that requirement from GASB is they're concerned with the liability impact. They're not concerned as we are at the board level with the contribution rate impact. So that's why when we were talking all this morning about the informational item, I would not be able to point to you what's the contribution rate impact, because that truly is a number that we have not calculated based on the 2016 data. But the liability impact is disclosed and provided right in front of you.
I guess finally on page 6, there's just more detail on how those numbers are developed, starting with the numbers from last year and how it gets rolled forward to this year. Not rolled forward, but how the movement happens from last year to this year. The last item on the bottom of page 6 is it expresses the net pension liability as a percent of the covered payroll. And the covered payroll was provided by MCERA. That's the actual payroll for the fiscal year ended 2016.
Ms. Harris?
Any question then, if we're getting information about potential differences and possible recommended rates in the future, we're looking to the next study. We have from Dr. Wilbanks, supposedly coming up shortly, work done on our COLA, being the Bay Area COLA or potentially the western states. How would that, or when would that fold in? Not for another year, or is that some kind of information that you might be able to bring to us next month?
I think typically for this type of informational item, we would like to study that one change at a time, if I may. If the concern, and rightly so, is on the impact of the change in the investment return assumption on the liability and hence the contribution rate, I would recommend to the board that we focus on that. I do understand that any time we change the COLA, the index you use to look up the COLA, that would have an impact, at least in the short term. But it's very possible the long-term things may work itself out, although I've been reminded all the time that California, especially Northern California, is always going to be more expensive place to live in. So if you use Western United States, maybe that would result in a lower number. But until the board take action to make a change, I would recommend that for that informational item, we make it pure by just studying the investment return assumption.
Okay, thank you.
Any other questions?
I just,
Mr. Knudsen?
does this get presented to the Board of Supervisors? Because it really only affects the county, doesn't it? And they've got to be 67 or 68.
Yeah, it is indirectly, so what happened is, once this report, skinny report is approved by the board, we would be and this is really for your comprehensive annual financial report, your CAP. Once that is approved by the board, we'll be started working on right away. A companion report is going to be a little bit thicker. It's going to be used by the county in preparing their financial report. They have a CAFR, as you know, to file as well. It's called the GASB 68. So I think in the past, we have been focusing our attention just delivering this product to you, the report to this board, and then we work with Dr. Wilbanks and his crew to complete the other report, and we'll just wait for questions to be asked by the county, their auditors, and we'll be, I think we have been in a more, a little bit better word, passive position with respect to the other report, because that report is truly provided just as a service to the county, but because they are the, not just the county, I mean to say court and the Secretary District.
Do you have a motion to approve?
I have a question.
Okay, Mr. Stevens?
Page 9, I have from 2014, I have end of this last year's, you use beginning of year deal, so I go to 2015, I look at the end of that fiscal year, I see we're supposed to have 488 in funding at the end, F, and I have 426. Should I be concerned about that as a fiduciary? You predicted we'd have 488 on all this. We have 426. Should I be concerned as a fiduciary, or is everything beautiful?
So Mr. Stevens, I think for this transcript, I'm looking at page 9.
I have 2 years before, the first one of these I ever saw, I proved them all
Right.
in prep for this meeting. I have June 30, 2014, I have the end of the year, you don't call it 16 there, you go by beginning of the year, you call it 15. It says that at this snapshot that we just had, I should have, if our plan is going to be fully funded, I should have $488 million in projecting and planned fiduciary net position. I go to what it actually is, it's 426 million. Should I be concerned, or is everything cool?
So I'm still trying to track the other number.
So on page 9 this year, it shows projected ending planned fiduciary net position,
Sure.
$426 million.
Yeah, that's the actual market value.
2 years ago, you told me it was going to be 488. You said this plan will be okay, it'll make it, and we have to have this progress on it, and it should be 488 by the end of the fiscal year ending in June 2016. I expected to have it be okay then, we were supposed to have $488 million.
Yep.
And if we had $488 million, it would just make it and just fund itself. I look today, we have 426. Should I be concerned, or is everything cool?
Well, you should be concerned, but under the following caveat, if you look at the contributions, if you look at the current report, the contributions are much higher than the contributions that we provided 2 years ago. The reason why.
Which should make it better, wouldn't it?
Well, no, because we have not met, and this goes back to the point during the prior conversation, we did not earn the assumed rate of 7.25. We have a negative rate of return, and the only way to, so remember, if we earn less than the assumed rate, doesn't mean that the retirees of our plan is going to get less from the pension system. So the only way to make up for that is to increase the contributions. So
that's what I tried to do in our last deal. That's exactly what I was trying to do, is increase the contributions for exactly the same reason. Thank you.
I move that we accept Segal's GASB 67 report.
Second.
Okay, any debate, discussion? Okay, Judy, roll call please.
Ms. Cavanagh?
Yes.
Mr. Sakowitz?
Yes.
Supervisor Drudy?
Yes.
Mr. Stevens?
No.
Mr. Walker?
Yes.
Mr. Knudsen?
Yes.
Ms. Harris?
Yes.
Ms. Shatner?
Yes.
Mr. Goodman?
Yes, motion passes. Okay, number 8, discussion regarding member contribution rate methodology. Dr. Wilbanks?
Thank you, Mr. Chairman. Trustees, you'll recall a number of months ago that there was a question regarding how member contribution rates, employee contribution rates are determined. At that time, I reached out to Segal and had a conversation and got some education for myself. I really thought it would be best, based on the information I learned from Segal, for them to come here and give you that information. What you have before you is a letter that they sent me explaining how the member contribution rates are determined for 37 Act plans. So I wanted to tie all this together as to why you're seeing this today. So with that, I'll turn it over to Andy and Dirk to kind of walk through how these contribution rates get set.
Okay, thank you, Dr. Wilbanks. In front of you are two very different methodologies we use to set the contribution rates. First and foremost, if you are a CalPEPRA member, meaning that you joined the MCERA plan after 1/1 on or after 1/1 of 2013, that calculation is actually very straightforward because we take the normal cost rate, and I think in our earlier report we look at the number more or less 20%, even though it's a total for the entire plan. But if I may use that for simplicity, take 20%, you divide it by half. Half of that would be paid by the employer, half of that would be paid by the employee. So that's where the 50-50 sharing of the normal cost came about under pension reform. So it's very simplistic, much more simple going forward. But it's only on the normal cost rate I want to emphasize. Take the total normal cost rate divided by 8.5, and that's how much the members would pay. And of course, that's how much the employer would pay as well. So that's the more simple approach. However, if you happen to be a member of our plan before 1/1 of 2013, you are a legacy, considered a legacy member, and that's what we use as a terminology in our description. If you turn to attachment, to the attachment, not the cover letter, but look at the attachment. I want to give you an example. The way the rates are set are actually very somewhat different, depending on whether or not you're looking at the so-called basic contribution rate, which is the rate to collect from the members without or before accounting for the cost of living adjustment. So we talked very briefly that our members are entitled to, at least in the legacy plans, are entitled to a cost of living adjustment, as you are aware, up to 3% depending on the CPI for the Bay Area right now, or maybe in some other index down the road. But the way we calculate contribution rate for the basic benefit without adjustment for COLA is actually very different from how we adjust the rate for the COLA. So let's focus on the basic. So this is the contribution rate without taking into account the cost of living adjustment. Now, under the 37 Act, rather than to use the same set of assumptions that we have alluded to in section 4 of our report, which takes into account not just interest rate, how long people live after the retirement and mortality table, how quickly or how early people retire from the plan, do they terminate before they retire from the plan, or do they come to sale? So we have a lot of assumptions that we have used in the valuation, primarily to get the total contribution rate, the 20% or so rate that we were talking a couple of minutes ago. But for the purpose of calculating the member rate, we don't use the full set of rate. The only set of assumptions, the only assumptions we use in that calculation are listed on in the middle of page 1 of the attachment. So those assumptions are rate of salary increases, the mortality assumption, so how long people live after their retirement, and also the investment return assumption. So that is it. So in other words, for the purpose of setting the contribution rate on the basic, which is without the COLA, those are the only 3 factors we are allowed to take into account. So some board members will ask, well, wait a second, how can you set a contribution rate if you don't know, or if you don't make an assumption as to when people retire from the plan? Because after all, it is very important. Now, if you look at the first paragraph on the attachment, this is how the law is set up. We have used Tier 3 as an example. There's no reason why we pick on Tier 3, but we just use that as an example because it's very similar for the other tier, safety, probation, and like. Now, under Tier 3, the best benefit that can be achieved would be if he or she retires at age 62, because for each year of service, that member can get a benefit which is roughly 2.6%, 2.62% of final average 3-year salary. So 2.6%. So if I have 20 of those years, then I get a benefit which is 52%. So 20 times the 2.6%. Now, under the 37 Act, this is a simplification, if I may use that term, number 1. Rather than to look at the unique experience for MCERA in determining when a member retire from a plan, the 37 Act says, forget about the actual experience. Every system, every county, which has adopted this formula, the 2.62 or 62 formula or the 31621.2 formula, has to assume that everybody is retiring at age 60. There's no exception. Even though experience has proven that our general members, if it were to be proven that our members actually retire a little bit earlier than age 60, or maybe some have retired a little bit later than 60, we cannot take that into account. We have to assume 60. Now, under that simplistic assumption, which is in the 37 Act, it says those members have to fund for a benefit which is 1% for each year of service at age 60. So now immediately we have a discrepancy, because not only do we not know whether or not our members retire at age 60, but as a matter of fact, if all of our members were to retire at age 62, and if we only ask the members to pay a 1% benefit for each year of service, but in actuality, if it were to be found that our members all retire 62, they get a benefit of 2.6%. So now we have a little bit of a mismatch. We think we will collect and pay a benefit equal to 1% based on the employee's contribution, but in reality, under my hypothetical example, if it were to be found that all of our tier 3 members retire 62, so those members actually will pay a benefit for his or her retirement, which is much less than 1/2. In the early example, when we're looking at the book, we say it's about 10% total normal cost, 10% or 11% of that is paid by the member. So this is one place where the assumption is actually different. Now, the other place is some of our members actually may never collect a retirement check from the system. Someone may someone may terminate employment before he or she actually get to retire. So this is another simplification where the law says you have to assume everybody's going to retire. So in actuality, if the member does not retire, pull out his or her funds from the account, that benefit, at least paid for by the employee, would be fine because we return the contributions. On the other hand, if you are the employer, we have been putting contributions aside, that money will be forfeited by the system and used to provide for other benefits. But there's no connection whatsoever with respect to what happened to the actual termination experience. We could be in a county where we have a lot of members who, for example, leave us and go to work and get thinking in hypothetical terms for Sonoma County. So that is not something that we are allowed to take into account if that were to be true.
Mr. Jurdy?
So I know we're all getting close to noon, but so I do have a question. So in this example, so this is tier 3, your example here is tier 3, so these are not PEPRA employees?
These are not PEPRA members. Okay,
so they would be getting a COLA of up to 3%.
That's right.
And, so I'm looking at your second paragraph on the attachment. The present value is calculated assuming a level benefit, i.e. no COLA. So
COLA is coming up because
so just to clarify, so you are calculating the COLA?
Yes, but that's calculated very differently. So that's why I want to separate the basic contributions from the COLA.
And then the second part of that sentence, payable over a lifetime, i.e. excludes the 60% automatic payable to a spouse, domestic partner. Is that calculated, like the inevitability that some employees will have the benefit passed on to a partner? That is captured into the formula?
That's captured in the formula, but only paid for by the employer. Because the 37 Act is very clear that when we calculate this value of the benefit, it's a lot of hypotheticals. Assuming that members would retire at age 60 in this case, assuming that members would only retire but not terminate employment. So the other hypothetical is assuming that they will only be collecting a lifetime benefit and no continuance would be paid to his or her spouse or domestic partner.
Okay, so just to recap, so you're saying that particular benefit in the 1937 Act is completely covered by the employer, not shared?
The continuance benefit in particular would be covered by.
And then the COLA is covered by both, but just in its...
Yeah, so to bring home that point, if you look at page 2, so that's how the COLA rates are calculated. COLA rates, on the other hand, are calculated very differently. There's already a 50-50 split of the cost to provide for the COLA benefit. And half of that is paid for by the employer, and half of that is paid for by the employee, and that is the case even before CAPEP. The cost to provide for a COLA benefit is already split. It's paid for, again, half by the employer and half by the employee. So that's the difference. And the basic rate is calculated under one method, a lot of hypotheticals.
So just to try to keep this as simple as I can.
Sure.
So if last year the COLA was 2.5%, and let's just say that had I don't know, I'm gonna toss out the wrong number, but if just say it was $1 million for that COLA, did 500,000 come from the current active employees and 500,000 come from the county sponsor, the plan sponsor?
Yes, so that would be from the fund, we don't ask for the members. Oh, you mean the contribution is 500,000? Yes, half of that would be paid for by the employer, half of that would be.
Okay, so the
paid by
current employees are paying the COLA to the retirees?
That's right. Oh, no, a paying as contributions to the fund. Now that the contribution is sitting in the fund, it will continue to grow and grow.
Okay, so it's based on the anticipated COLA.
That's right.
And so this would also, just my final point, so because the Pepper employees have 0 COLA in their plan, they, I assume, are not paying into the fund for the COLA, for those who have it.
That's right. So in other words, when we calculate the total normal cost rate for the Cal Pepper folks, there's no anticipation that they would ever get any COLA.
Yeah.
So if you look at the normal cost rate, they're much smaller. One of the reasons why they're small, besides the less rich formula, benefit formula, is because they don't have any COLA. They don't have any cost.
Thank you.
Any other questions? Okay, this, we need to rush everything on this now.
Is that, was that, do you have more, Andy?
No. I think these are the current rules, as I always like to say, because I think one of the provisions that is put into the Cal Pepper tiers is to allow the employer and the bargaining parties to change how sharing works for the legacy members. So I will just leave it at that. It's just, it is allowed. It is not mandated, unlike the Cal Pepper tier.
So, if I could, Mr. Chair, in summary, the question was, how are that started the whole conversation on this was, how are employee contribution rates set? And can we change those to ask employees to contribute more? And my takeaway from all of this is that the contribution rates are set very, very specifically in the 37 Act. And this board has no authority to ask legacy members to pay more. There may be some provisions through the bargaining process for that to happen, but that's outside of our purview. There's, Andy outlined how the contribution rates are set, very specifically from 37 Act. There are 3 assumptions that can impact that, and only 3 assumptions that we make that can impact that. So I hope that answers the questions that the board was interested in. If not, Andy and I'd be happy to do some more work. I say I only peripherally. Andy and Dirk would be happy to do more work if we need more information.
All right, thank you. Oh, Alan.
Can I ask a question? So just to make sure I'm clear, you're saying that you can't make recommendations for legacy members to increase employee contribution rates. However, under Cal Pepper, is it 2018 when employers could mandate that or impose that change? Is that impacted at all by 37 Act of law? The employer still has the authority to impose that on employees regardless of 37 Act of law?
50% of the normal cost is
50%
that
of
question?
normal cost,
I think it's part of a negotiating item or something like that.
Yeah, my understanding is, again, looking to Jeff for the final answer. My understanding is bargaining has to take place, bargaining has to come to an impasse, whatever that means, and only then can it be mandated. So I think there's still a set of rules that needs to be followed. It's not automatic, it's what my understanding is.
Well, right, my understanding is that after 2018, that can be imposed by the employer. However, my main question is, can that action happen regardless of 37 Act law?
If the Marin County case stands, yes.
How about our attorney?
So, if you're asking me a bargaining question, I've heard this issue discussed. I think it's really a county council question, if I'm understanding your question correctly. I do agree with Andy, but I think that's a county council question because you're talking about, can you unilaterally impose or do you have to go through the bargaining process? I'm not quite sure I'm understanding your question.
I think it's a bargaining process.
Yeah, so I think that's a county council.
Well, it's a bargaining process up until 2018 is my understanding, after that deadline.
So that's the question, what happens
But-
after 2018?
But regardless, is there a conflict between what CalPEPRA put in place in 37 Act law that would preclude that from happening, whether it was through the bargaining process
It's
or?
a Marin County case. It's Pepper says one thing, and California contract law, under the California rule, is assumed to say something else. And if the Marin County case stands, Pepper would be followed. If it didn't stand, it wouldn't. It's my reading of the law.
Craig?
I'll put on my Deputy Sheriff's Association hat. My understanding is that it's two separate issues as far as the Marin case is concerned. And there is no conflict, that it can be imposed after a bargaining process in 2018. There would be some sort of impasse, whatever that means. And I would also note that at least our association agreed to pick up the normal cost during our last contract, so hopefully that's a mute issue, at least for us.
Mr. Jordan?
Just a question, Jeff, so I guess I was thinking that the PEPRA law actually amended the 1937 Act, or is it a standalone law?
No, it's now part,
Yeah.
it is part of the 37.
Okay.
Anything else? All right, thank you, Andy and Dirk. Have a safe trip back.
Thank you.
And
Thanks.
we're gonna break, perfectly 12 o'clock, we're gonna break till 12:30 exactly. And we'll bring the meeting back to order. Item number 9, monthly financial report, Dr. Wilbanks.
Thank you, Mr. Chairman. Trustees, you have the financial report before you. I'd be happy to ask Stan to answer all the questions that I don't know.
Any questions? Nobody?
Yeah, I do. Let me get back to it. I was looking at the budget, the budget. I just wanted to go over and that includes the expenses at the end.
Whatever's on the financial report included in number 9.
So, including the vendor ledgers?
If that's included, if that's in number 9, yep.
Any other questions before I go to the vendor ledger?
Go ahead.
So, I just saw a quarterly budget, I didn't see a total year budget, so, Galena, $35,000, is that the total amount we're paying them this year, or we're paying them more than that?
That's progress billing for the auto field work that was completed in September.
So there's more coming?
There's more, but that's most of it.
Okay. And Segal having 20-something, 22,000 or whatever, I saw 25,000, is that, how much more what's their total deal, do you remember?
I'd have to go to.
We paid them earlier already too, right? Or was that a one-off type deal?
I believe the majority of what we paid them before was for prior quarter billings. Maybe the GASB 68 report and some other ad hocs.
Are you referring to the invoice and the vendor ledger this month? That's what you're referring to?
Yeah, so I'm looking at $27,000, $26,000. Is there, have we paid them more in this fiscal year?
That bill you're referring to, that's for 68 reports and 67.
Some of that's for 68 or 67? So it doesn't include the actuarial report we saw today?
It does not.
And again, why are we paying for the 68? I understand why we pay for 67. Why do we pay for 68?
Yeah,
Why doesn't the county pay for 68?
It doesn't really matter who pays for it. The cost has got to be paid. If we allocate that cost to the county, there's really not much of a difference. I mean, it's just we can allocate that cost, but it all comes from the county anyway.
If they bill us for IS services, they're billing us for.
Well, I'm gonna argue that if I was a participant in this plan, and you were making a contribution rate based off including the expense for GASB 68, which is included in the investment expense, I would say, why am I paying for that? And you're saying, well, it's de minimis, and you're right, but I think It's not for the benefit of the employees in the plan, it's for the benefit of the county doing their financial statements, I understand, chapter 68.
We can certainly look into that, and if it's the board's pleasure for me to research that issue, I can do so.
I
Whether
think
we
we
should
actually made a
allocate that-
decision to pay, to have the
I would
county.
strongly recommend against making any decisions without time for staff and legal counsel and our actuary to consider all the impacts.
County bills us for services, so I don't know why we can't bill them for services. So I agree with Ted, I think.
We can certainly do that. My recommendation to you would be that before making any decisions, that you ask your staff and experts to look at the issue and bring you a recommendation.
Agreed.
Right,
Okay.
look at the issue. Okay, any other questions? All right, we'll move on to item number 10, quarterly budget update. Okay, Dr. Wilbanks.
Thank you, Mr. Chairman. Trustees, you have the quarterly budget update, as mentioned in the cover memo. Because this is just the first quarter of the fiscal year, the quarter and fiscal year to date are one and the same. That's why you only have 2 schedules in the report. I'd be happy to answer any questions you may have about the budget.
Ow. Okay.
Any questions? I have a question, on the actuarial services. It shows, 26,000 actual, but only 1,500 budgeted. Why, and there's a $24,000, $525 difference, what's that about? Is that because they, bill us before because the rest of it's in the next quarter, or?
Those are late bills from prior year that just received in September.
So Segal billed us late?
Yes.
Okay. So last year we should have had a, under budget?
Compared to what, I'll have to look at what we did last year. Yeah, but it was, to answer your question, 67, 68 were budgeted into last year's budget. Those expenses were.
Going to, pulling up last year's fiscal year to date budget. No, that's actual. I won't go to budget. That's the quarter. We came in over budget last year by 21,394, but we'd have to go through and do the research on as to why that happened.
Technically, last year we were over budget by 40,000, Segal, if this was the prior year budget, prior year amount.
Possible. We'd have to dig into it and better understand, not just the budget amount, but the actual amounts as well. So,
Curious about that. Any other
Just,
questions? Mr. Knudsen?
in looking at the one that shows fiscal year 2017, July to September budget in the first column, and then actual in the second column, did you just take the total, the yearly amount and divide it by 4, or how did you come up with? Because I was wondering on the same question, why was $1,500 for Segal? We surely paid them a lot more than $1,500.
I based that off of last year's cash flow for paying for Segal, so $1,500 is quarterly retained.
So this is based on what happened the same quarter last year, okay.
Anybody else?
Yeah, I can explain what's happening in Custodian Bank, State Street.
Nothing.
there's just a lag in billing there. Is that?
Yeah, exactly.
Yeah.
We don't have anything budgeted for that, or?
Well, we had them last quarter, and if there was a lag, I was expecting to see something from, we paid late, but they were timely before and not timely this time, or?
Exactly, yeah, they haven't, follow up with them, because they haven't been consistent with their billing.
They are consistent with us being able to get numbers when we push a button though?
Yeah,
That part's okay?
yeah.
Good.
Anything else? All right, move on to item number 11. Discussion of possible action regarding service level agreement between the Mendocino County Chief Executive Office and the Mendocino County Employees Retirement Association. Dr. Wilbanks.
Thank you, Mr. Chairman. Trustees, you have the agreement before you between MCERA and the CEO's office for services provided. The services specifically covered in this agreement are IT support and the facilities maintenance and management, which we have been using extensively. The prior agreement had lapsed, and there's new language in this agreement to recognize and bring all that in and effectively have the two agreements be the same across all three time periods, the prior contract, the intervening period, and this contract. So,
Mr. Stevens?
If we didn't do this, what would we do?
if we didn't do this, then I would have to go find someone else to provide services for us, or we would have to try to do it in-house.
Are their rates cost efficient?
I believe they are. I've not done an RFI or an RFP for comparable services, but I think these are competitive.
Yeah, they are.
Your recommendations, we adopt it?
Yes, and I will apologize. I had a cover memo that I didn't get in the board materials. This agreement brings up an issue that the board may wish to consider, in that this is just a standard ongoing type of agreement, but I have no authority to execute this under our existing policies. The board may want to consider delegating some level of authority to execute agreements, because we have some other agreements that will be forthcoming in the coming months, that quite honestly are not at your pay grade. They should be delegated for staff to just handle.
Oh, you're ready to bring that forward, or are you looking for a recommendation from the board to bring that forward?
I'm looking for direction from the board on that matter.
I think you'd have to bring back a policy that would.
Yes.
You'd have to revise an existing policy.
Yeah, there would be.
So right now, there's some language that talks about it, but there's no delegated authority.
So
James didn't like my answer.
No. His answer was exactly what I was.
Yeah.
There is no decision today,
Right.
but maybe some direction from the board to bring back some amended policies.
This fiduciary gives direction, thinks we should give direction to the retirement administrator to do just that, and to have him come back with a dollar limit or time frame which he thinks is reasonable for the retirement administrator to be able to execute a contract.
Everybody agree?
Yes.
So directed.
Very good.
I make a recommendation, we approve this agreement with the county for services.
Make a motion or a recommendation?
I make a motion.
I'll second.
All right, we have a motion and a second to adopt the service level agreement between Mendocino County Chief Executive Office and the Mendocino County Employees Retirement Association. Any discussion? All right, Judy, roll call.
Ms. Cavanis?
Yes.
Mr. Suckowitz?
Yes.
Supervisor Jordy?
Yes.
Mr. Stevens?
Yes.
Mr. Walker?
Yes.
Mr. Knutson?
Yes.
Ms. Harris?
Yes.
Ms. Shatmeyer?
Yes.
Mr. Goodman?
Yes. Okay, item number 12, discussion of possible action regarding renewal of fiduciary liability insurance coverage. Dr. Wilbanks.
Thank you, Mr. Chairman. Trustees, you have a handout before you with a memo and a recommendation and some information about some fiduciary liability insurance options. This is another one of those that has not come before the board before, but there are some options that are available to you now that were not offered previously, and I wanted to put this out there specifically for discussion of the board to see what the pleasure of the board is. And I didn't have any authority to just make a decision on this, and even if I did, I don't think I would on this matter. So I'd be happy to try to answer any questions you may have.
What's covered, thank you, Mr. Chairman, what's covered by the 3 different policies?
The 3 different policies cover the same, all of the same,
It's just the limits of damages?
limits of liability are
Okay.
different.
Okay.
That is the only difference between the 3 options.
And where's a copy of the policy itself?
I don't think, we did not put that before you because it's, I don't even know how many pages it is.
Okay, all right. Thank you.
Some significant number of pages, 75 or something like
Wow.
that. I can't even
Okay.
remember.
Now, is this liability, is that per trustee, or is that just total, total?
I believe that's an aggregate.
Has our council looked at it?
So, I looked at this about 3 or 4 years ago for Sonoma, and they used the same company, and, we spent a fair amount of time. And it's not easy, and when the issues come up, like any kind of insurance, you know, what's the scope of the coverage and what's considered a fiduciary cause of action, and what about selection of counsel, and how much money will they cover, and, you know, I know the 37X Council have looked at this and compared notes, and this is about 3 or 4 years ago, and I think this is about as good as you can do. And I did pass on to James, because I just happened to come across it coincidentally, a list of the 2037X systems to see what their liability amount was. And 5 is the minimum, and I think you and, of course, 2 other small systems, and this is maybe a little bit dated, 3 or 4 years ago, had a $5 million limit. LA and Orange had a $25 million limit. Most of the systems, I think, had about 10. Nobody actually had 7.5. I didn't see that on the list. But there are 2 or 3 other systems, Imperial, Merced, and maybe one other that had 5 million. And you know, that's kind of a typical insurance question. You know, is it worth another, what, $8,000-9,000 to go up 2.5 million? We haven't had a case, at least since I've been here, and in the years I've been doing it for Sonoma, we had 1. And you know, like I said, we did butt heads a little bit with insurance on that, although we've now since switched to this company.
Mr. Stevens?
This is for the investment council. If James wants to speak in, that's about, he can speak to it, that's fine too. Would, if you were gonna try to make a decision on the amount of coverage that we needed and looking to the relationship of the other associations, would you say that it's just the nature of the business we're in? Or you could make some nexus to the amount of assets, or some nexus to the amount of members in the association? The point is, we're really small. Is 5 adequate, or do we have the same liability? It's, you know, there's no real economy of scale. We have the same liability as anybody.
So I think that's a good question. And I don't think there's an easy answer. I mean, in some ways, we have the same issues as anybody else, but we do have a smaller number. I mean, that's really a tough call. And to be honest, the other piece is, I mean, when I review contracts for the county, we rely a lot on risk management. I did have our county, Sonoma County Risk Management, take a quick look, and I shouldn't be saying this on the record that they're looking for Mendocino. But, although, you know, I guess it's connected with the work that I do for you, so I think that's okay. And they took a quick look, and nothing jumped off the page at them like, oh, there's some inadequacy. So, you know, 5 versus 7.5 versus 10 million. I mean, it's a hard call to make.
If we had a claim and it blew through the coverage, where would that additional liability lay? With the assets or individual trustees?
Well, you know, there's this separate thing that you guys do for, right, you pay the $25 or some nominal amount
Pay $10.
$10.
$10?
Uh-huh.
Well, they're
Pretty
paying
good deal.
25, and so now I'm not sure the difference there either.
Is that for this or this?
That's
It's a
okay.
separate one.
It's a waiver of recourse.
What was your question?
So is this protecting, would this, if they blew through this 5 million, you went in with 5 million, who would be liable? Would it be trustees and the assets in the plan? Or in the county, or would it be only the assets in the plan?
So I suppose there's some cause of action that could really go against a particular individual, but I don't see it that way. I mean, I think it's the plan. I don't see it as an individualized thing.
So it would come out of the assets of the plan?
Right.
Well, hold up, Mr. Walker.
Was there some reason that this is before us today, or is this just in the normal course of business?
This has not come before the board previously, is my understanding.
I'm surprised it hadn't.
It's been, because it's just been continuation of what we've previously had, and it's been within the budget, we've just renewed it every year. At least in the 2 years I've been
Yeah,
here,
I've
that's
never
what
seen
we've
it
done.
before.
So there's no particular issue, it's just.
No, it's just a, yeah.
It's just a
Right.
regular course of business.
This time we
Should
had
have come
options, so I felt it was important to bring it to the board to have a discussion about what's the appropriate limit of liability they wanted. And there was also the question of, do I have the authority to just do this?
Yes.
So,
Ms. Cavanagh?
Is it also would be like similar to the piercing the corporate veil if an individual of this group did something that is, obviously unethical, and that as an individual, they would not be covered by this?
So I believe it would be the same as the advice I would give if it was the Board of Supervisors, and that is, I think what you're saying is if there is an individual trustee who really acts outside the course and scope of employment, I suppose that this body could decide to not defend and indemnify that person.
Well, somebody
I mean,
did-
that could be contested, but I believe that is how it would proceed.
Somebody wasn't a county resident? Does that make them, isn't that one of the rules?
Elector.
Elector. What
Mr.
is an
Sackles, did you have
elector?
your?
Yes,
I
did.
Register to vote?
Vote.
Wherever you vote? Is
That's
that
what
it?
37X is.
Okay.
Thank you, Mr. Chairman. So just a couple of quick questions. I sit on a couple of other boards, and is it generally true that the California Corporations Code holds harmless most boards of directors of tax exempt boards?
I don't know whether that would apply here.
Okay. Second question is, we've had a couple cases come before this board where matters of determining the calculation of benefits. Does this policy cover damages in those areas?
Yeah, I think that could be. I think if they make a claim that your decision breached your fiduciary duties, that this policy could be implicated.
Okay, great.
So,
Thank you.
Anybody else? We have a motion, what? If we should go with 5 million, 7.5 million, or 10 million?
I have no particular frame of reference other than the discussion now, but I'll make a motion that we stay with the $5 million figure.
I'll second.
Okay, any discussion? Debate? Okay. Judy?
roll call, please.
Oh, we have a motion and a second on staying with our current policy of $5 million. Judy, roll call, please.
Ms. Cavanagh?
Yes.
Mr. Sackowitz?
Yes.
Supervisor Drudy?
Yes.
Mr. Stevens?
Yes.
Mr. Walker?
Yes.
Mr. Knudsen?
Yes.
Ms. Harris?
Yes.
Ms. Shatmeyer?
Yes.
And Mr. Goodman?
Yes.
Can I ask a question here? Because
Oh, sorry.
I thought this was being brought by James because he wanted us to see the two different companies and the
Well,
one
the same company, right?
Same
It is
company.
same company. Okay.
Alliance.
But I thought some of the benefit or some of the coverage was different.
Yeah.
It's the limit in liability.
Just a couple.
You had option 1, 2, or 3. That's the only difference.
But I thought it was the dollar amount was different.
Really
The
annoying.
limit of liability aggregate
Yeah.
is different. That's the only difference between the three.
Premiums are.
And the premium, yeah.
Well, but on this chart, it shows present policy, same except for either the policy itself is changing. That's why I thought it was two companies, but okay.
Oh,
No, we're gonna have the exact same policy, correct, that we had before?
no.
There are some changes to the policy. We were not offered the present policy, we were offered
Okay, got it.
options 1, 2, and 3.
Can I ask a quick point of information, Mr. Chairman? I've never seen this before. What is, to legal counsel, what is section 502 of the Pension Protection Act?
I don't know off the top of my head.
Okay.
So in reviewing this, we did line ours up with what Sonoma County recently renewed, and there was some initial proposal that was not in line with some of the things that Sonoma County negotiated, and we were able to negotiate a Me Too in that and get everything that they had included.
Looks like they've increased coverage on the proposed.
And they've supposedly done pretty good due diligence on this?
Yes.
But that wasn't you, that was someone else though, wasn't it, Jeff?
Well, I was the one who did it back in 2012, and then they did make a few modifications since then. And I know that was done quite heavily.
Thank you.
Okay, let's move on to item number 13, discussion of possible action regarding employment agreement with James Wilbanks for the position of retirement administrator.
Who's that guy?
Dr. Wilbanks?
Thank you, Mr. Chairman. Trustees, you have the contract before you. This will be submitted, if you approve this, it will go to the Board of Supervisors, and we have already scheduled that for December 6th at the regular Board of Supervisors meeting that day.
And on regular agenda, right?
Yes, regular agenda, not consent.
This is the same contract we all saw last month and approved.
Gave direction.
Gave direction, excuse me, yeah, gave direction. Any comments? Okay, have a motion?
Motion to accept?
I'll second.
Okay, we have a motion to accept the employment agreement with James Wilbanks for the position of retirement administrator. Okay, Judy, any discussion? Wait, okay. Judy, roll call please.
Okay, Ms. Cavanaugh?
Yes.
Mr. Sakowitz?
Yes.
Supervisor Jordy?
Yes.
Mr. Stevens?
Yes.
Mr. Walker?
Yes.
Mr. Knudsen?
Yes.
Ms. Harris?
Yes.
Ms. Shatner?
Yes.
And Mr. Goodman?
Yes. Okay, move on to item number 14, discussion of possible action regarding fiscal year 2016-2017 budget amendment. Dr. Wilbanks.
Thank you, Mr. Chairman. Trustees, you have before you proposed budget amendments. There are two items included here. One would be the increased personnel costs, assuming that the new contract with the retirement administrator is approved by the Board of Supervisors. The other is moving expenses from the building maintenance line item up into the administrative costs, as explained in the memo. I'd be happy to answer any questions you may have.
Any questions for Dr.
So-
Wilbanks?
So the building maintenance being moved to administrative expenses, why would it not just be considered as part of the real estate investment?
Cubicles are not permanent.
Okay, so you're talking about interior,
Yes.
okay,
Yeah.
not the roof repair and all that?
Not anything else. It's simply building workspaces out here to better utilize our space. And the plan is to get cubicles to build 3 separate workstations out here. 2 for the client services staff, and a 3rd workspace where we will have the scan station, the video recording station, and we'll move the photocopier or copy station or document processing into that workstation. And then by moving the client services staff into workspaces in this big area, we will open up the workspace where Katie currently works, and we will change that and use it as a client meeting room where we can actually meet with clients and protect their confidentiality. Currently, our only option for doing that really is to use the boardroom. So that's a much better solution for us long-term.
We need a motion on this?
Yes.
Okay, we have a motion?
Yes, sure. Motion to accept.
Second.
Okay, we have
Actually,
a,
it's to adopt.
To adopt.
okay, we have a motion to, and a second to adopt the 2000, fiscal year 2016, 2017 budget amendment. Okay, Judy, roll call please.
Ms. Cavanagh?
Yes.
Mr. Segalowitz?
Yes.
Supervisor Jordy?
Yes.
Mr. Stevens?
Yes.
Mr. Walker?
Yes.
Mr. Knudsen?
Yes.
Ms. Harris?
Yes.
Ms. Shatmeyer?
Yes.
Mr. Goodman?
Yes. Okay, item number 15, discussion of possible action regarding resolution 2016-03, adopting a conflict of interest code. Dr. Wilbanks.
Thank you, Mr. Chairman. Trustees, you have a memo and a proposed resolution before you. We are required to adopt a conflict of interest code, and in working with legal counsel, well, I recently became aware of this requirement. As soon as we became aware of it, worked with legal counsel to put together a code and a policy, which we will consider in the next item. We are required by state law to have such a code and submit it to the county, which we will do if this is adopted. I'd be happy to ask Jeff to answer any real questions because I don't know that.
Mr. Dirty?
So, just as a practical matter, many of us are already filing the 700 form, and we turn, like I turn them in because I've got so many reports, turn them to the county clerk. They then forward them on to the, so is that in practice what's happening now, or will that be what happens in the future?
I think you should be doing two. I have to do two as well. It's a separate agency. I'll confirm whether you have to do two.
Well, you can do them on, because I have to do one for the auditor appraiser, and then I have to do one for here, and I just include it on the, they have like I include it on the same 700.
So do I.
You can put it on like if you have a sub-agency or something like that on there.
Oh,
Like the
right.
format allows for that.
Is that what you're asking?
Yeah, and I give like an attached list of the reports and it gets attached to it, but the county clerk's office then forwards it to these, so I'm not running down
Oh, right.
different boards
Yeah.
and turning in.
Right.
They don't forward it to us.
They don't?
I think they should be.
So we'll
We'll
work with
check
the
it. We'll check on that.
county clerk's office to make sure we're getting everything we should be.
Any other questions? Do I have a motion?
I move we adopt the proposed resolution.
Okay, second.
Second.
Okay, we have a motion and a second to adopt the resolution 2016-03, adopting conflict of interest code. Judy, roll call please. Oh, any discussion? No. Judy, roll call please.
Ms. Cavanagh?
Yes.
Mr. Segalowitz?
Yes.
Supervisor Jordy?
Yes.
Mr. Stevens?
Yes.
Mr. Walker?
Yes.
Mr. Knudsen?
Yes.
Ms. Harris?
Yes.
Ms. Shatmeyer?
Yes.
Mr. Goodman?
Yes. Okay, moving on to item number 16, discussion of possible action regarding adopting a conflict of interest policy. Dr. Wilbanks.
Thank you, Mr. Chairman. Trustees, attached, included, you have a proposed conflict of interest policy that incorporates the conflict of interest code that you just adopted and provides further information to trustees and staff around the conflict of interest policy and also adopts a policy review schedule of every 2 years. I would recommend the board adopt the proposed policy.
Comments, discussion?
Just a question, is this just based on a model from some other
Yes,
organization?
yes.
So no, I worked on it a few years ago. It's not the law doesn't require you to have this policy like it does the conflict of interest code. It's a policy call about the policy. I mean, there are some sections and there's some references to that on page 3. I mean, that comes out of the law that stemmed from issues that were going on with the CalPERS board when folks left and came back and tried to sell investments. So that's legally required anyway, as is that biennial ethics training. But the other pieces to it are kind of a statement from the board about how you view your role.
Any,
I move we approve the conflict of interest policy.
I'll second.
okay. We have a motion and a second on adopting the conflict of interest policy. Judy, roll call. Oh, any discussion? Judy, roll call.
Oh, wait, no, I have discussion on it.
Pardon?
I have discussion.
Sure.
So if I have clients in this county, they're taxpayers in the county, does that, do I have a conflict?
Explain.
If I have a client that I am advising from either a tax standpoint or an investment standpoint or some other financial standpoint, do I have a conflict because they are a taxpayer in the county?
Is there something in particular you're reading from? Because that doesn't sound to me like
Shall not
Form
transact
700.
shall not transact any business or influence the transaction of a business in the individual's official capacity with any entity or person in which the individual has an economic interest privately.
That would be official capacity as a trustee, wouldn't it?
So on 700, I have to list anybody in the county I deal with. I have to list any businesses I have. I have to list any of the wine grape growers I have that sell grapes here with over a certain amount of money coming in. So is this broad enough that if I have a individual client who's a taxpayer in the county?
I don't think that's the intent of the conflict of interest policy.
Okay.
If we had investments with somebody in the county and you represented them, that, I would think that could be a conflict.
Yeah.
But I don't think unless we have some investment here.
So if I had a client that was doing some joint development with the county, I couldn't deal with that client personally in my capacity as an advisor?
I wouldn't think unless we were involved with them on this board, not the county. I mean, I'm not the.
I don't really want to deal with the hypotheticals, but from the specific example you gave me, I don't see an issue with the conflict of interest policy at all.
Okay, thank you.
All right, so we have a motion and a second. Do we have any other questions or discussion? Okay, Judy, roll call please.
Okay, Ms. Cavanis? Yes. Mr. Suckowitz?
Yes.
Supervisor Jordy?
Yes.
Mr. Stevens?
Yes.
Mr. Walker?
Yes.
Mr. Knutson?
Yes.
Ms. Harris?
Yes.
Ms. Shotmeyer?
Yes.
Mr. Goodman?
Yes. Okay, item number 17, discussion of possible action regarding direction to MCERA, State Association of County Retirement Systems, SACRS, business meeting delegates. Dr. Wilbanks.
Thank you, Mr. Chairman. Trustees, you have the business meeting packet in your materials. There are maybe 2 items on the legislative agenda. It's unclear to me based on the recommendations on the cover page of the SACRS business meeting, whether those 2 will actually be brought before the membership and a vote taken. But just in case, I think it would be healthy. I think it's necessary for this board to give direction to the voting delegate of where this board stands on the 2 items. That's the MECERA number 1, alternate retiree voting, and Ventura number 1, transfers of leave balances. And I apparently will be the voting delegate, so I need direction.
Do we have any recommendations?
I think we're all tired.
So to clarify, this only affects MECERA
Yeah.
and Ventura?
The alternative.
I don't think so. I
Alternative,
think
alternative.
the MECERA number 1 changes the 37 Act to allow the public safety alternate to vote in instances where 2 other elected by membership trustee positions are vacant at the time of the vote, other than the public safety member. So Merced has a public safety member and an alternate public safety member. Not every board has that. But Merced brought this request because they actually had an issue where they had lack of a quorum because the public safety and the public safety alternate were there, but there was only one vote between the two of them, so they didn't have a quorum. So they brought the request to help them actually conduct meetings. And the SACRS board saw that as specific to one retirement system, therefore they didn't recommend it as applying to the whole membership. If it's brought before the body for a vote, I think I need direction on how this board would like to vote.
Well, isn't this kind of what we wanted to do anyway, where we wanted get the alternate to, so why would we be against this?
This board sent a letter to the Board of Supervisors recommending that the Board of Supervisors pursue legislation for Mendocino County to have an alternate for the supervisor appointees, not the elected from the membership members.
Oh, that's right, yeah.
This says retiree, or alternate retiree voting. In my position, not the safety position, as I'm reading it. That you would modify alternate retiree trustee voting rights? It's not talking about public safety in the one I'm reading.
Okay.
Yeah, it's talking about the alternate retiree would get to vote.
So if the two,
If there's no alternate safety.
yeah, if the two safety people aren't there, the alternate retiree member votes, right?
That says the absence of two board members at a meeting, so it doesn't matter who it is. Two board members, then the alternate retiree can vote in where there is no alternate safety member.
Okay. So they're voting for, if there are any two board members gone, so those could be the ones appointed by the supervisors too, that the alternate retiree voting rights goes, he can vote where there's no alternate safety member in place. So he can transfer over his vote to the other seat that's not served. For me, I wouldn't vote for it. The reason we sent that to that came up and we sent what we did to the Board of Supervisors, because we felt this was giving even more power voting to the 2/3 side. And reading it now is even if those the independent people are gone, we would get to have the power voting. You know, pours it on. It doesn't say from the members, the side that's the members of the plan. I'm very uncomfortable with it.
So, do we want to vote no on that one?
I would recommend that we vote no.
I would too.
And then what about the second one, the Ventura number one?
Question, the last sentence here on the Ventura one, says that there's some language here about the governor signing another bill September 30th. Do we know if that happened or not, or?
AB 1853 was vetoed.
Okay.
So that's why it's conditionally approved, or recommended for conditional approval. 1853 was vetoed. That's why I don't know if this proposal will be brought before the SACRS body. But again, I think it's important, in case it does, that I have direction.
I don't know about the rest of you, but I have no idea what an independent operating authority is, or what the abbreviation DOR is. Okay, I'm sorry. I would note that the SACRS board did not support the Merced effort, but would be in favor of this Ventura, right, pursuing this, and I don't see on the surface that we would have a disagreement with the SACRS board on this. So I would make a motion that we approve it as written.
Well, as I'm reading the recommendation, it said now the governor has vetoed this.
Right. Based on that.
We need a second.
Then it says they will recommend that Ventura pursue clarification as a single system effort. So, do we vote on this now that he vetoed it?
I don't know. I don't know if it will come up for vote. I suspect it will not, but if it does, without direction, I can't vote by
Not to
our
be a
policy.
stickler, but we're talking without a second.
Well, we're still in discussion phase. Did we,
Well, there was a motion and then there was no second.
was there a motion?
Tim.
Oh, Tim.
Or Craig.
Yeah, I stuck
Oh.
one in there.
Oh, I'm sorry, thank you.
And I'll
Let's-
second for purpose of discussion.
Can we get, did that include both items in it? I don't know, a
I
motion include-
I thought we had put Merced to rest.
Well, we still have to, like, let's get a motion that has both items, and so we want like no on, on
All
number
right,
one
so I
and
will
yes on number two.
amend my motion then that we do not support the Merced effort, and based on the assumption or the knowledge that AB 1853 was vetoed, that we would support, if I'm reading this correctly, the SACRS direction to Ventura to pursue it further on their own.
I'll second.
Okay, we have a motion to vote yes on Merced number one, or no on Merced number one, and yes on Ventura number one. And we have a motion and a second. Any discussion?
Question,
Mr.
do we have an alternate safety member?
No.
There's no provision in Mendocino County for an alternate safety member.
We do have, we do have
Actually-
an
Nobody
alternate,
runs, nobody's ran.
but it's between fire and safety.
Can't,
Well, we don't have
We don't have-
fire.
But no one's come forward for it, right?
There could be an alternate safety member here, but it would have to be from a different plan provision or type. So we have two public safeties groups. We have the public safety and we have safety probation. If there were someone to seek the spot that Craig now sits in from the safety plan and someone to seek it also from the safety probation plan, between those two, whoever got the most votes would sit in the active seat, and whoever got the second most votes would become the alternate. We have not had anyone from safety probation apply or submit to be on the ballot to be a trustee. So we've not had a safety alternate trustee.
I read it again after we had a discussion about this, and I read it that the alternate safety can only come from fire, not from any other type of safety person. I'll read it again when I get home.
That was my understanding, we had a conversation, and I wanna say maybe it was with Jim or maybe with Rich, just because sometimes it's very difficult for me to get to meetings on a consistent basis. And the conclusion was that, remembering the conversation, that it had to come from fire, and since we don't have fire, there was no provision for an alternate.
Yeah,
I just have a vague memory of that discussion, but I don't recall.
Yeah, I do, and I'm not gonna swear to it, but,
Well, we should bring it back sometime, just so we know for the future. It's too late for today, this
Well,
election,
you're
right?
good for
Well,
3
it's
years,
not-
right?
yes, I am, yeah.
It's not a current issue.
No, it is not. I
It'll
don't,
come up again for 2.5 years.
well, I don't, from a procedural standpoint, I guess it is a mute issue. It would be nice, I think, to have an alternate, but I can't. I don't believe it's possible.
I remember a little differently. I remember no one came forward. That we looked at it and it was possible, but there wasn't anybody interested. That's what I thought.
I thought probation could fill a seat. I didn't think it was strictly fire, but I'm not.
They don't have fire in there,
Yeah.
and I always get confused on all the different deals, but.
We'll have legal counsel and our administrator.
Yeah, maybe I can flush it out just for edification.
Okay, we have a motion and a second. Any other discussion?
Can we clarify the motion?
Okay, the motion is that we're going to vote, that we're directing Dr. Wilbanks to vote no on Merced number one and yes on Ventura number one.
Got
Okay? All right, Judy, roll call, please.
it. Ms. Kavnis?
Yes.
Mr. Seckowitz?
Yes.
Supervisor Jordy?
Yes.
Mr. Stevens?
Yes.
Mr. Walker?
Yes.
Mr. Knudsen?
Yes.
Ms. Harris?
Yes.
Ms. Shatmeyer?
Yes.
Mr. Goodman?
Yes. All right, move on to item number 18, Retirement Administrator Report. Dr. Wilbanks.
Thank you, Mr. Chairman, trustees. A couple of things. We've announced our holiday hours. We will be closed on the Wednesday before Thanksgiving, closed to the public. Any employees that wish to work that day will be able to do so, but we will close the doors to the public so that everyone can spend time with their family if they wish. Additionally, following what the county, I believe, will be doing this year, is we will be closed the week of Christmas. So December 26th is a holiday. We will be closed that day anyway. We are closing to the public December 27th through the 30th as well. We also have, next month is the month to bring a $10 check for your waiver of recourse payment. Please remember to do that so Judy doesn't have to hound you. Two other things that were not on the agenda. I sent an email to everyone about a one-day training at the Markets Group. It's in Napa Valley, if anyone's interested. It's a very, very full agenda. It's investments specific most of the day. If anyone is interested in that, please let me know, especially those of you who need hours. And we will get you signed up to do that. Please let me know now or today, because it's in 4 weeks, this meeting. One other item is I've been approached by the county CEO about the possibility of another joint Board of Retirement, Board of Supervisors meeting. And from my perspective, nothing has changed much from the previous joint meeting that we had. I don't see that there would be a great deal of value to it. I think we would be much better served by looking towards 2 years from now when we could have a joint meeting after the experience study and the new valuation based on that experience study. I'd be looking for your thoughts and input on that. If anyone's dying to have another joint meeting or sees no real value in it, I can communicate that back to the CEO's office.
I would agree with what you just said. It doesn't seem like there's anything that's really changed. It seems like it would just be a repeat of what happened last year.
$40 million.
Well, I mean, as far as talking about the discussion, I mean, chances are that would be another Segal trip is probably what you do. So to me, it would just be very similar to last year. It seems like if we did it every 2 years, that would
$64 million against our net worth. Additional $64 million.
But it's to have that discussion.
This fiduciary, I mean, you heard me today. I mean, we're all nice people and like each other and everything, but
Right.
this plan is a train wreck. We're 67% funded and losing money, and we don't want to talk about it. And we have participants that is very questionable if they're ever going to see any benefit. The county's putting in money, they're putting money in, we're taking investment returns off, and their money never goes in the plan, and the plan's continuing to go down, and we have benefits that are going out in increasing amounts. No money going in, siphoning off the returns. This is a train wreck. There's no question this plan's not going to be able to meet its obligations, in my opinion. You could say, well, Segal, they really know their stuff. Okay, they really know their stuff. Every one of them's a loser. Every plan that has a loser. I wouldn't have any clients if I did that. Every time they've struck out. We're probably about, the best funded place they have is probably high 70s. This is a problem. And to say, okay, we don't need to talk to anybody about it, we'll do it later. You can do that, but there are people in this county that aren't going to get paid their pension. And we can continue to kick the can down the road, but the problem is you're never going to get ahead of it. So, I mean, I know the pleasure of this board is not to talk about it. But,
I think we talk about it all the time.
I do too.
Then, show me, put your finger on any of these reports. I have Talmad's report here at Segal. Please put your finger where it's improved. I've been looking at this thing for 8 years. Please show me somewhere where there's improvement.
So the purpose of the meeting would be what? Till we get Segal up there and have everybody up there tell them how bad they are, or what? I mean, what would be the purpose
It's
of this,
disclosure of where
of
we
this
are.
joint meeting?
If we don't have a meeting, it's implied everything's cool.
Are you feeling like that we need to have a
I
meeting?
think we need to ask
I
Pam.
mean, from the board of supervisors perspective, you do the actuarial report in front of the board of
They're the
supervisors.
same side of the
You
table
could
here.
pack, I
They
mean, you
want
could
probably
pack,
get away.
but I'm just saying, you could pack the boardroom, if it's the actuarial study that you wanna look at, they're gonna do that report to the board of
Open
supervisors.
session,
Open session, you can pack the boardroom, everybody can listen to it, everybody can get up there and do their 3 minutes. I just don't know what the purpose would be as far
Sure,
as.
you're a long-term employee, been in this county over 30 years, right?
Yeah,
You got employees that are working for you that have put their money in, subtracted from their paycheck every cycle, and they put it in towards a retirement plan. The county's making a very large contribution on their behalf too. It never goes in the plan. The plan is continuing to get less funding. Don't you feel some obligation to make sure that everybody in the world's aware of this
do
problem?
you think that the county employees are gonna show up at the joint meeting? They're not.
I think that it's gonna show,
I mean, I'd like to know.
if
that.
it isn't our responsibility and the supervisor's responsibility, whose responsibility is it? And if we're gonna turn our back on it, say, yeah, we'll look at it in a couple of years. We did $40 million. We just lost $40 million. To me, it's material. We just wiped out our net worth. A third of every tax revenue that goes to you in your position goes just to pay the unfunded liability without paying anything else. You got a problem. And if we just say, yeah, it's gonna get better, are we gonna really look at it when it gets about 40%?
I'd like to know what Supervisor Journey thinks.
Well, so just for clarification, so the Segal 3-year study is coming up when?
Next year.
After the June 30th, 2017 data point. So we will do a
Like November,
triennial.
like October, November?
They'll come back in probably November next year
2017.
to present their experience study, yes.
Then we'd have a lot to talk about.
Well, I'm just thinking because it's been in the last several years in January when the joint meeting takes place. And that's probably why she brought it up. Yeah.
Well, we said in the meeting we're gonna get back together. We said in the meeting with the public that we're gonna get back together.
Mr. Sackwitz?
Just
Meeting in
curious,
January. The Board of Supervisors said, right after we said, I'll guarantee that everybody's pension is gonna be paid. I wish it was a personal guarantee.
Mr. Sackwitz?
thank you, Mr. Chairman. I've got a lot of respect for CEO Angelo. I'm just curious, Dr. Wilbanks, did Ms. Angelo express any particular need to have this joint meeting, or was it just on her list, tickler list of things that had come up?
I'm not sure. It was brought up to me that there was some interest, and I don't know if it was hers or the Board of Supervisors or where it was coming from, but there was some interest in another joint meeting, or maybe it was just on the calendar. I don't know what her motivations were.
Well, why don't we have Dr. Wilbanks get with the CEO's office to find out what the motivation is and come up with and when they might want to meet, and come back next meeting with a little bit more information on where they're coming
I
from.
think that's a good idea.
Okay, I can do that.
Just one, when is Segal gonna report the actuarial report to the Board of Supervisors? Any idea? Is that December, is that January?
I would guess no sooner than December, yeah, because of the getting on the.
Yeah, no sooner than December. Historically, it's been January. Of course, historically, we've gotten our valuation reports in December. So we could look at moving it into December. I have a call scheduled with Mr. Young tomorrow to talk about scheduling issues. So
I'd like to know what the rest of the board thinks, as far as if they think it's a useful, if it's useful for us to spend our time at that meeting.
Well, before we even really get into that, let's find out what the CEO's office is, where they're coming from, when they think they might.
Well, they may want to know though before.
Well, that's not gonna happen in January, I can guarantee you that.
Okay.
Well,
that's.
that was what was communicated to me, was there was some expectation that we would do it again in January, and
Look how long it took them to schedule the last one, I mean, it's not gonna happen in
The
January.
natural time to do it is when Segal's here, so you don't have to pay for them. And they give their report, and then we discuss it and let the public be aware.
Right. I don't think that's a bad idea on the face of it. I'm curious as to, and you'll probably get this through, Ms. Angelo, what's the pleasure of the other 4 other supervisors?
That's
what I
I
said.
would look
We
to
need to get
Supervisor Jurdy to provide that
I
information.
think just in general, we've agreed we're gonna have annual meetings, and it's last couple of years, it's been in January. But, so I suspect what may have prompted is that I know that they're in the process at staff level of crafting a calendar for next year. So that may be what they're looking at, penciling in a certain day in January.
I don't know if it's all, well, the holidays coming up, and I don't see it happening in January, but maybe just get some more information on it.
Find out what I can.
Thank you.
Who's chair of the Board of Supervisors next year?
John McCown.
John McCown. All right,
That concludes my report, Mr. Chairman.
any other questions? All right,
This turns off too.
okay, move on to item number 19, general board member discussion. Any discussion? Okay.
Thought of one more thing. The Cowan conference is coming up in January. If you're interested in that, please let us know so that we can get reservations made accordingly.
Mr. Stevens?
Yeah, you don't need to discuss it necessarily with the board, but you should probably clarify, because I never got back to you because I saw questions come on our budget meeting that seemed to be unclear when you put out and retracted. So do you want to speak to that? I mean, I think I understood it, but I held back, and I was gonna go say, yeah, I'm available, but it seemed like it wasn't understood by the other trustees on the board.
So there was, I created a meeting in GroupWise, which in my humble opinion is one of the absolute worst email and calendaring
Tell me
systems
about it.
ever. And did not make sure I had all of the details correct. If you do it in something like that in any other calendaring program, you can open the item back up and change the time, but not in GroupWise. So I put one invitation out with the wrong time, start time on it, retracted that, and put another invitation out with a 9 a.m. start time on that. So 9 a.m. on
On the
December
6th.
6th is when we have scheduled an audit budget committee meeting to review the audit draft at that point.
So 9 a.m. December 6th.
December 6th,
And when is your contract up before the Board of Supes?
December 6th,
Same day?
same day, yes.
That's what I thought, so how is this possible?
But get rid of our meeting, go to the other one, right?
Oh, we could have your thing on the agenda later in that.
I will work with the clerk's staff to find out when my item will be.
Because I wanna be there to support your contract.
I don't think it will happen first thing in the morning, and I'll work with the clerk's staff. to
If you
make
could
sure.
give me a heads up, because I do wanna throw in my 3 minutes of public comment on the contract. Thank you.
All right. That adjourns the meeting until next retirement meeting, which is
I'll take it.
scheduled,
I'll claim it.
just scheduled Wednesday, December 14th, 2016 at 8:30 a.m.
Thank you, Randy.
Thanks,
Very good.
Thank you very much.
Yes, Randy.
We're gonna
You
miss
signing
it.
it? Yes. No, I haven't signed it.